calculator with you. We are doing some important numerical based on unit 7 and unit 8. Right, let's start. Let's start with the first case study that we have. Right, this case study exactly I have taken from the December examination. Right, so this is a set of 5 questions, and let me explain what the question is all about. So here you can see, आप यहाँ पे देख सकते हैं, this is the data of financial data of firm A, firm B and firm C for the year 21 and 22. So let me highlight the data. Right, and as you can see, just wait a minute. Yeah, okay, now it is okay. Now you can see the first particular is sales. Let me zoom a little bit so that the picture become clearly visible to you. I hope it is visible now. So you can say the sales is given, all the data have been given in lakh. Sales is 50 lakh, 60 lakh and 80 lakh. Variable cost, EBITDA. You know what is EBITDA? Earning before interest, tax and depreciation. That is called EBITDA. That is given, right? 15 lakh, 17 lakh and 20 lakh. And then, then we have interest cost, which is a part of fixed, right? And then depreciation and amortization, which is the fixed cost, right? And then we have the tax. So these data have been given, right? Such type of case studies are asked in the examination. Good evening everyone. So I hope everyone listening to my voice, right? So this is the financial data of the firm A, B and C. Now let's see this question. I will मैं आपको दोबारा इस ये slide provide कर दूंगा. I will again provide you the slide. Now let's see the first question. Based on the above data, what is DFL of firm A? You have to calculate the degree of financial leverage of the firm A. This is a conceptual session. We will try to understand the concept using solving numerical. हम लोग अपने concept clear करेंगे numerical के माध्यम से, right? That is what this session is all about. So you have been asked to calculate DFL. What is DFL? Degree of financial leverage of firm A. Options are 1, 1.33, 1.5 and none of the above. Let me again come back to this slide. Right, everything we will do on this slide. Now friends, you know what is the meaning of DFL? Right, you know what is the meaning of DFL? DFL पता है आपको क्या होता है? Let me explain a little bit about this DFL. So DFL means degree of financial leverage. It tells us how much a company profit before tax. There's something called EBT, that is called earning before tax, right? Or we call it profit before the tax. So it tells us how much EBT change in the response to change in EBIT. Right, how much EBT change in the response to the change in EBIT. So the formula for DFL is, what is the formula for DFL? Right, what is the formula for DFL? The formula for DFL is very simple, that is EBIT, earning before interest and tax, upon EBT. Right, this is the formula for calculating the DFL. What is EBIT? EBIT means earning before interest and tax. What is EBT? EBT means earning before tax. Now friends, how to calculate this EBIT and EBT? Right, let us calculate it step by step. I am telling you the exact procedure how to go about calculating this EBIT and EBT. Right, so what I will do, I will draw a pie chart. This is a technique which you can use to easily calculate this EBIT and EBT. Let me explain. Right, what you do, suppose you draw a pie chart like this. Fine, so what is the total sales? Look at the firm A, look at the data of the firm A. Right, this is a technique which I use to solve such kind of problem. And if you use it also, it will be very easy. ये जो टेक्निक है, इसको आप यदि यूज करेंगे तो आसानी से आप EBIT और EBT निकाल सकते हैं. Let me explain. So what is the total sale? Total sale is 50 lakh. So I will write here 50 lakh. Okay. Now out of this total sale, some portion of the total sale is our variable cost. So let's say this portion. I'm writing in red color. So this portion is our variable cost. Variable cost is how much? Variable cost is how much? It is 30 lakh. Now can you tell me what is the contribution? Right, what is the contribution? So contribution is this portion, right? This portion which I am highlighting by the red color, which I have highlighting by the red color. This is called contribution, right? So how much will be the contribution? Our contribution will be how much? Let me use the different color, right? Let me use green color. So our contribution will be 20 lakh. How did we get the contribution? So contribution is nothing but sales minus variable cost, right? So sales is 50 lakh and variable cost is 30 lakh. So 50 minus 30 is 20 lakh. So contribution is how much? 20 lakh. Now let me ask you a question. If suppose the company increase its variable cost, will contribution go up or go down? Please answer. यदि मान लीजिए कि कंपनी अपना वेरिएबल कॉस्ट बढ़ा देती है तो कंट्रीब्यूशन बढ़ेगा या घटेगा? Just waiting for your response. Suppose the company increase its variable cost, will the contribution go up or go down? Suppose variable cost increase, instead of 30 lakh it become 40 lakh. What will happen to the contribution? Will it go up or will it go down? Now, this is the first step. We have to calculate the variable cost and then the contribution, right? So obviously it will go down, right? The contribution will go down because, yes, obviously it will go down because, you know, more cost means less margin, right? If the cost is more, it means less margin. Now, after that, we have calculated the contribution, which is 20 lakh. Let me erase this particular point, right? So basically this particular half, so let me draw another half here, right? So I'm just drawing it half here. I hope it is visible to you, right? So this portion I am representing. You know, this portion, right? So it consists of two things. You know what is given here? EBITDA, right? EBITDA is how much? Let me erase it. Just wait a minute. So now you can see EBITDA, earning before interest, tax, and depreciation of the company is how much? 15 lakh, right? What is the earning before interest, tax, and depreciation of firm A? It is how much? It is 15 lakh, as you can see, right? So, and what is the depreciation? So first of all, let me again draw it. Just wait a minute. Let me again draw it. So this was the pie chart which we draw, and this was the contribution, right? So this was the contribution portion. You know, some portion of the contribution, right, is the profit, and the rest portion is the fixed cost, right? So as you can see here, what is our contribution? Contribution just now we got 20 lakh, right? And what is our EBITDA? Earning before interest, tax, and depreciation is 15 lakh, and how much is the depreciation? Is 30 lakh. So you can see earning before interest, tax, and depreciation is 15 lakh and depreciation is 3 lakh. So just subtract. What we will do, how to calculate EBIT? Earning before interest and tax is equal to earning before interest, tax, and depreciation minus depreciation, right? So if we subtract depreciation from EBITDA, we will get what? We will get EBT. We will get what? EBT, right? So how much is the EBT? EBT is how much? 12 lakh. Is it clear? EBITDA minus depreciation. If you subtract, you know what is amortization? What is the meaning of amortization? Please tell me. Yes, obviously. Amortization, amortization is the depreciation in terms of intangible asset. देखिए asset दो तरह के होता है. Asset are of two type, tangible and intangible. For tangible asset, we call depreciation, and for intangible asset, like let me give you one example, like patent, right? For patent, depreciation is called amortization, right? So we have to calculate what? We have to calculate EBIT, which is earning before interest, tax. So what we will do, from EBITDA, we will subtract depreciation, we will get EBIT, right? How much it is? 12 lakh, right? And then we have to calculate EBT, which is earning before tax, right? How to calculate EBT? Please tell me how to calculate EBT. Can you calculate EBT for me? So it is quite easy. From EBIT, if you subtract the interest part, if you subtract the tax part, interest part, right? How much is the interest? You can see it is 4 lakh. This is the part of fixed. So what will be the EBT? Can I get some responses? Please tell me what is the EBT? Very easy question it is. So from EBIT, if you subtract the interest part, you will get what? EBT, right? How much is the EBT? Please tell me. So it is nothing but EBIT minus interest. So EBIT we have just calculated 12 lakh. And how much is the interest? Interest is 4 lakh. So 12 minus 4 is how much? 8 lakh, right? So now we got EBIT, now we got EBT. What is asked in the question? To calculate the DFL, that is the degree of financial leverage. What is the formula? EBIT upon EBT, right? EBIT upon EBT. So what is the answer? 12 upon 8. So what it will be? 1.5, right? So the correct answer to this question is option number C, 1.5, right? So this is the step you have to follow to solve such type of problem. Yes, option B, yes, obviously EBT is 8 lakh, right? And DFL is what? DFL का formula क्या होता है? DFL is EBIT upon EBT. So 12 upon 8. This is equal to how much? 1.5. So how to go about solving such type of problem? Let me explain. See. So what is the meaning of this 1.5? Is 1.5 का क्या meaning है? Do you understand the meaning of this 1.5? Let me explain. This 1.5 means that, right, if profit change by 1%, right? See, this 1.5 means that if operating profit change by 1%, right, then profit before tax, PBT, change by 1.5%. So this indicate, if DFL is higher, it means financial risk is higher, right? If DFL is higher, it means financial risk is higher. So what we did, you see, first of all, we have EBI TDA, which means interest before earning before interest, tax, and depreciation and amortization. You must know the full form, right? Earning before interest, tax, depreciation, and amortization. From EBI TDA, right? We subtracted what? We subtracted the depreciation. We get what? We get EBIT. And from EBIT, we subtract the interest. We get what? EBT. And now we have EBIT. Now we have EBT. We just find their ratio, and then we will get the the DFL, right? Is it clear? I hope it is clear. Please let me know it is clear or not in the chat box. One more question I want to ask you, that suppose if the country has, if the company has no interest cost, suppose no interest cost is there. Suppose if the company has no interest cost, what will be DFL? DFL will be what? Option A, 1. Option B, greater than 1. Option C, less than 1. What do you think? Suppose no interest cost is there, what will be the degree of financial leverage? Just waiting for your response. Is it 1? Option A, 1. Option B, greater than 1. Option C, less than 1. In this case, you can see interest cost is there. How much is the interest cost? Interest cost is 4 lakh. Suppose no interest cost is there. How much will be the DFL? How much will be the degree of financial leverage? Please let me know. Waiting for your response. Just make this session interactive. I want your response, because let me see whether you understand DFL clearly or not. DFL means what? EBIT upon EBT. Suppose no interest cost is there. What will be the DFL? That is what I am asking. DFL कितना होगा यदि interest cost नहीं है, interest cost 0 है तो, right? I am not getting any response from your side. Yes, very good. Option A, 1. Very good, right? Yes, it will be 1. Option A is the correct answer. It will be 1. Why it will be 1? Because if there is no interest, then what will happen? EBIT and EBT will become same, right? If there is no interest, then what will happen? The EBIT will be equal to EBT, right? And the ratio will become equal to 1, right? So this is the point. Now let's see the next question. Question number 2. Among the 3 firms, which one has the highest DFL, right? Which one has the highest DFL? Firm A, Firm B, Firm C. So firm A, we have just calculated DFL, it is 1.5. Can you calculate the same for firm B? Please calculate the same for firm B. Just write in the chat box how much you are getting for firm B. Question is asking which is having the highest DFL. Please calculate for firm B. And let me know in the chat box what is DFL for firm B. Because once you calculate the DFL for each firm, then only you can say that this one is having the higher DFL, higher degree of financial leverage, right? So what is the DFL for firm B? Please calculate. So let me explain. For firm B, if you calculate the DFL, right? So DFL, it is EBIT upon EBT, right? And so for firm A, you can see we have just calculated 1.5. If we calculate the same for firm B, EBI-TDA 17 lakh, and from this EBI-TDA we subtract the depreciation, so we get EBIT. EBIT is how much? 14 lakh, right? And from this we subtract the interest, so we get EBT, which is how much? 10 lakh. So for firm B is how much you are getting? Tell me. EBI-TDA minus which is our 17 lakh minus depreciation, which is 3 lakh, 14 lakh upon EBT, which is EBT. Further we subtract this interest cost, which is 4 lakh, right? So how much you are getting? It is 1.4. Are you getting the same 1.4? Please let me know. Yes, 1.4. Very good. What about the firm C? For firm C, EBI-TDA is 20 lakh, and depreciation is 4 lakh. So 20 minus 4 is 16 lakh. 16 lakh is your EBIT. And what is EBT? So EBT is, right, for firm C, 16 lakh minus 6 lakh, which is the 10 lakh. For firm C, it is 1.6, right? So for firm A, we have got how much? 1.5. So for firm A, it is 1.5. For firm B, it is 1.4. And for firm C, it is 1.6. Now, can you tell me which one is having the highest? Yes. So option number C is the correct answer. Firm C is having the highest, right? So 1.6 is the highest, right? So that is why the answer to this question will be option number C. Firm C is having the highest degree of DFL. right? Now let's calculate what is the DOL of the firm A, right? What is the DOL? So the question is, what is the degree of operating leverage of the firm A, right? So let me come back to this question. So here it is asking you to calculate what is the degree of operating leverage for the firm A. Till now we were discussing about the DFL, that is degree of financial leverage. Now it is asking us to calculate the DOL, that is degree of operating leverage. So do you know the formula for DOL? Let me explain. Let me explain what this DOL is all about, right? So DOL tells us if the sales increase by 1%, how much will be operating profit increase. So it tells us that if sales increase by 1%, suppose sales increase by 1%, what will happen to our EBIT? How much our EBIT will increase? In other words, it shows us how much a business benefit or suffer from the change in sale, right? So what is the formula for DOL? So you don't need to remember in the derivation part. You just need to remember the formula. That's it. You know the formula for DOL? The formula for DOL is contribution upon EBIT. Contribution upon EBIT. Remember this formula, right? Contribution upon EBIT, right? Yes. So you need to remember the formula of DOL, that is contribution in the numerator and EBIT in the denominator. Now the question is asking you to calculate the DOL of firm A. Now can you tell me what is the contribution of firm A? Just now we have calculated the contribution from the sale. We have subtracted the variable cost. So contribution from firm A is how much? C is how much? 20 lakh. We are talking about the firm A, right? हम लोग firm A की बात कर रहे हैं, right? So contribution upon EBIT, that is what is DOL, right? That is what is DOL. So now basically it shows the impact of sales on operating profit, right? Now let's calculate the DOL. What is contribution for firm A? It is 20 lakh. I am waiting for your response. And what is EBIT for firm A? Please answer. What is EBIT for firm A? So EBIT, we have just calculated the EBIT for firm A. It is how much? So EBITDA, which is 15 lakh, minus depreciation, which is 13 lakh. So 15 minus 13. If you have any doubt, please let me know, right? I am here to clear your doubt. यदि आपको कहीं भी कोई दिक्कत है कुछ समझने में तो प्लीज मुझे बताइए कमेंट चैट बॉक्स में, मैं उसको दोबारा बताऊंगा. Just now we have calculated the EBIT, right? So EBIT is how much? EBITDA minus depreciation. So it is how much? 12 lakh. So now what you have to do? You have to put contribution in the numerator. What is contribution? Contribution is 20. And what is our EBIT? It is 12. So 20 upon 12, which will be how much? Nearly about 1.67, right? So let me come back to this particular question, right? So option number D is the correct answer. 1.67 is the correct answer. Is it clear? How did we get? Please write clear in the chat box if this concept is clear to you, right? So one more question I want to ask you, that if company has, suppose if company has no fixed operating cost, if company has no fixed operating cost, suppose company has no fixed operating cost, right? What will be DOL? What will be DOL? Option A 1, option B 0, option C 2, option D can't say. What do you think? Suppose a company has no fixed operating cost, what will be DOL? Option A 1. Yes, very good. It is clear. Now please answer this. Suppose a company has no fixed operating cost, what will be the DOL? 1, 0, 2 or can't say. So basically, let me explain this DOL in clear term. So whenever I draw this particular pie chart, just wait a minute. Let me draw it more clearly. See, whenever I draw this particular pie chart, right? So this portion I am referring to, this portion, it consists of two things. This is the variable cost portion. This is the sales portion. It consists of two things. One is the fixed cost, and other is the profit, or we call it EBT, or we call it EBIT, right? So some portion is fixed cost, some portion is EBIT. So whenever I say DOL, so and this entire thing is called contribution. This entire thing is called contribution. So if we zoom into it, right? So let me draw it further. If we zoom into it, so this entire thing is what? Contribution, and some portion of this is what? EBIT, and some portion of this is what? The some portion of this particular portion is your fixed cost. Now what I'm telling you, that this, and what is DOL? DOL is the ratio of contribution upon EBIT. That means numerator we put this much and denominator will put this much. So this ratio is called, this ratio is called DOL, degree of operating leverage. Now what I'm asking you, that if fixed cost is 0, tell me, if this fixed cost will become 0, what will happen? This entire thing will become EBIT. right? This entire thing will become EBIT, and that is what our contribution is. So contribution will be equal to EBIT, so our DUL will be equal to 1. So the correct answer to this question is option number A, that is 1, right? Is it clear or not? Please let me know, because you know why I'm telling you graph, because using graph you can remember it. Sometime what happen, you will get confusion that what is whether for dual in dual whether EBIT in numerator or contribution in numerator. So using graph, I'm giving you graph, I'm giving you pie chart to make it clear. Very good, right? So what will happen if there is no if there is no operating cost, if there is no fixed cost, what will happen? The entire EBIT will be equal to contribution, and that make this ratio equal to 1, right? So using graph is the most perfect way. You did not remember any formula, just remember the graph, right? And you can solve any kind of question based on DFL or DOL. This case study exactly was asked in the examination, right? So just now I've told you how to find the DOL. The answer to this question is 1. So the DOL shows the impact of sale on the operating profit, right? And you know, the more fixed cost, if the fixed cost is more, if fixed cost is more, right, it means DOL will be higher, right? And it will be more risk plus more reward, right? Now that is the point. Now let's come back to this question. Among the three firms, which one has the highest DOL? Now let's come back to this question. Which is having the highest DOL, right? Now please do the calculate DOL for rest other, for B or C. So for A we have just calculated, it is 1.67. Please calculate DOL for B and C. Let me calculate it. What is DOL for firm B? Right. What is DOL for firm B? Let me do the calculation here. So what is DUL for firm B? So you can see sales is 60 lakh, variable cost is 36 lakh. So contribution will be how much? 60 minus 36 will be equal to 24 lakh. So contribution, we are talking about firm B. For firm B, contribution is 24 lakh, and you know the EBIT for firm B is how much? So EBITD is 70 lakh and depreciation is 30 lakh. So it is 14 lakh. And now if we want to calculate DUL, which is contribution upon EBIT, which is 24 upon 14, how much you are getting? Please let me know how much you are getting. 24 upon 14, right? Yes, very good. Now please tell me what is 24 upon 14, how much you are getting. Similarly, if you calculate for C, contribution is how much? Sales minus variable cost, so it is 32 lakh. Contribution is 32 lakh for company C, and EBIT is how much? EBIT is, you know, EBITDA minus depreciation, so 20 lakh minus 4 lakh, which is 16 lakh, right? So DOL for firm C is how much? 32 lakh upon 16 lakh, which is equal to 2, right? For firm C I am getting 2. What about firm B? It is nothing but 12 upon 7, which is nothing but 1.7 something, 1.7. Are you getting the same for DOL? Yes, 1.71. Very good. For company B it is 1.71, for company C it is 2, and for company A we have just calculated it is 1.67. So which one is having the highest DOL? Tell me which one is having the highest DOL? It is firm C, right? It is firm C. So what is the correct answer to this question? The correct answer to this question is firm C is having the highest DOL, right? I hope it is clear now, right? So firm C is having the highest DOL. Now let's see the last question. What is the DCL of the firm A? That is called degree of combined leverage, right? This is the third last question, right? So what is the DCL? What is the DCL of the firm A, right? So 2, 2.5, 2.75, and option D, none of these. What do you think about the DCL? Let me come back to this particular question, right? You know what is degree of combined leverage? How to find the degree of combined leverage? So simply what you do, the formula is very simple, right? We just have calculated DUL, which is 1.67, and we have also calculated the DFL, which I think it was again 1.67. What was the DFL? So EBIT upon EBT. So EBIT we have calculated how much? 15 minus 3, which is 12, and EBT we have calculated, you know, that is divided by 4. Yeah, that is, you know, 8. So it was 1.5, I think. So this was DFL. For firm A, DFL is 1.5 and DUL is 1.67, and you have to calculate DCL. DCL is called degree of combined leverage. You know, DCL is a product of DFL and DUL. Remember it. If you find the product of DFL and DOL, you will get DCL, right? Very good. So multiply DFL and DOL. So please tell me what is the answer? What will be the DCL of firm A? Please tell me. So DCL is the product of DFL and DOL. So 1.67 multiplied by 1.5. How much you are getting? Please let me know. right? So let me show you the option. Let me show you the option. So these are the option we have: 2.00, 2.50, 2.75, none of the above, right? 2.505, very good. 2.505. So option number B is the correct answer, right? So we have just now learned three things, right? First of all, DOL. So degree of operating leverage. It tells us how EBIT react to the change in sale, right? Then we talk about DFL, degree of financial leverage. So how earning before tax react to the change in EBIT, right? And when we multiply both of them, we get DCL, right? So we show the total effect, right? So I hope the concept is clear. We have discussed 5 questions and we know how to calculate them. Now let's see the second question, right? Let's come to this particular question. Let's see what it is all about. Very important question it is, right? A company named ABC Limited, right? So basically what is happening here, a company named ABC Limited, right, took a loan of 50 crore. It has took a loan of 50 crore, right, from banks. But unfortunately, due to market slowdown and internal problem, right, basically it could not repay. It failed to repay. Now listen carefully. During restructuring, during restructuring, 10 crore of the loan, you can see 10 crore of the loan was converted into equity share of the company. So 10 crore of the loan was converted into equity of the company. The bank even got a seat on the company board. You can see the bank got a seat on the company board, right? But could not sell those share due to poor marketability. Now the question is, now the question is, based on the question, which of the following statement is most accurate? Option A, there was a pre-planned conversion executed as per the original loan agreement. Option B, the bank willingly converted loan into equity to earn higher return from the rising share price. Option C, this is a restructuring measure where loan was converted into equity due to repayment stress. Option D, the conversion gave the bank significant profit through dividend and capital appreciation. Right. So what do you think? Which statement is more accurate? Right. Yes. So which statement do you think is more accurate here? So let me explain like a story. You can understand it, right? See, imagine you gave your friend rupees 50,000. Suppose you gave your friend rupees 50,000 as a loan, but your friend lost his job and can't repay. You decide, okay, instead of cash, give me 10% ownership in your startup. You hope the startup will grow someday. That is exactly what is happening here. Bank converted part of the loan to the company's share, hoping for future recovery. Right. So, do you think that converting loan into equity is a safe move for the bank? Yes or no? Right. Do you think that converting loans, basically what bank have done that they have converted loan into equity. So, do you think that converting loan into equity is safe move for the bank? Right. Yes or no? Is it safe for the bank? What do you think? Obviously it is not safe, right? The answer is no, because it is risky, because bank are not a stock market investor, right? They prefer a steady repayment, right? So what do you think is the correct answer here? Which is the most appropriate, most accurate? So option number A suggests that there is a pre-planned there was a pre-planned conversion as per the original loan agreement. No, there was nothing like that. Basically it was a restructuring decision, right? And what about option B? The bank willingly converted loan into equity to earn higher return. No, this is also not correct, because it sounds good, but not the case. The bank did not expect profit. It was more of the damage control move. Option C suggests that the conversion was a process of restructuring. Yes, this is the correct answer. Right. This conversion of loan into equity was done for restructuring. Right. Option C is the correct answer. Right. And option D, the conversion gave the bank significant profit through dividend. That is also not wrong. That is also incorrect, because the share did not sell well. Clearly written, na, the valuation post conversion, right, but unable to sell the share. Right. It is clearly written that bank was not able to sell the share because of poor marketability. So bank got zero return. Right. So they got only a seat on the board. That is why option C is the correct answer to this question. Right. So what we learned from this question, is that loan to equity conversion is a restructuring tool. Remember, this is a kind of restructuring tool, not a profit making strategy. Right. And bank use this tool when borrower can't repay. It gives some kind of control, but also exposes them to market risk. Now let's see the second one. Let's see the second question. I hope the concept is clear. Converting loan into equity, right? What is the point? Now let's see this particular question. What is happening here? A company named XYZ Infrastructure Limited, right? It takes a 100 crore loan. It takes a 100 crore term loan to build a power plant. They want to build a power plant. That's why they took a 100 crore term loan, right? It was a huge project. Now the plant will take 4 year. The plant will take 4 year to build and will only start earning money after the year five, from year five, right? So the bank say, all right, we will give you 4 year moratorium. We will give you 4 year moratorium on the principal repayment, right? You will only pay interest during construction, right? But then XYZ bank come and say, we don't even have cash to pay interest right now. Can you also give us break on that? So question is, what do you think a moratorium means? Which of the following best explain the concept of moratorium? Option A, moratorium refers to complete waiver of both principal and interest. Option B, it is default remedy applied when a borrower is unable to repay on time. Option C, it is pre-agreed period where principal repayment is deferred to match the cash flow timeline. And option D, it allows borrower to delay repayment indefinitely until profitability is achieved. So what is the meaning of moratorium? That is what is asked here. What do you think is moratorium? Right. You can think of it like this way. Suppose you took a loan from your friend to open a restaurant. It will take 2 years to set up before you start earning. So would it make sense if your friend start asking for monthly repayment from the day one? Obviously no. So you tell your friend, give me 2 years, let me build, let me earn, and then I will start repaying you. So that 2 year break, that is called moratorium. Now what do you think? What is the correct option to this question? Is it A? Is it B? What do you think about option A? Right? Moratorium refers to complete waiver of principal and interest. What do you think? So, what about option A? Do you think option A is correct? See, here we are talking about, here we are talking about infrastructure project. See, option A is saying complete waiver of principal and interest. That is called, write off. That is called write off, right? The option B is saying remedy after a default. So this is called, this is incorrect because, moratorium is pre-planned. It is not punishment, right? It is a grace period. Option C is saying it is a principal repayment deferred to match the cash flow timeline. This is the correct answer. This is the exact idea of moratorium, especially for long gestation period and delay the profit until profit coming. This is completely incorrect. So the correct answer is option C. So what is moratorium? Moratorium is basically the grace period, right? Moratorium, it is basically a grace period, not a loan holiday, right? And it is mostly used in project finance where cash flow start later. So principal is deferred. Remember, principal payment is deferred. Interest is usually payable. Interest is not deferred. Interest is usually payable unless agreed otherwise, right? So in some agreement it may be possible that interest is deferred, but in most of the cases principal is deferred unless agreed otherwise, right? It is not a default, it is a part of the original plan, right? So remember, principal is deferred to match the cash flow timeline. That is the point. That is all about the moratorium. I hope that makes sense to you. Now, friends, let's see the next question that we have. So this is again a numerical based question. Let's try to solve this one. Let's try to break it down. So question is, as you can see, PQR Limited, right? So what is happening at the PQR Limited, a steel manufacturing company? Total revenue 150 crore, variable cost 90 crore, fixed operating expense excluding depreciation is 20 crore, depreciation and amortization is 5 crore, interest on term loan is 6 crore, and interest on working capital loan is 2 crore. The company is seeking additional funding and the bank want to assess whether PQR is in position to handle more interest obligation. So the question is, that means can they pay interest comfortably? So basically the question is, what is the interest coverage ratio for PQR? This question is most frequently asked. What is interest coverage ratio? Right. So the question is asking, okay, no connectivity. Okay, fine. Please let me know, am I audible to you? Is the slide clear? Please let me know. I think there was connectivity issue in between, right? So please let me know if everything is okay. Is everything okay on your side? Is voice and audio or slides are okay or visible to you? Okay, fine, clear. Now friends, let's come back to this question. See what is happening in this case. Let me explain. So imagine that you earn rupees 1 lakh per month. Suppose you earn rupees 1 lakh per month, right? And you pay 20,000 for food, right? You pay 15,000 for rent. You pay 10,000 for transport, right? And then you still need to pay EMI of 20,000. You pay EMI of 20,000. So before taking more loan, would not the bank ask that how easily can this person pay their EMI with the current income? That is exactly what ICR tells us. Interest coverage ratio tells us. See, this is a classic example to understand this ICR, interest coverage ratio. Again listen to my example. Suppose you earn a 1 lakh rupees per month and you spend 20,000 on food, 15,000 on rent, 10,000 on transport, and 20,000 EMI you have to pay. Now suppose you want to take more loan. So before taking more loan, bank will ask you how easily can this person pay their EMI with the current income. And that is exactly what ICR is. That is called interest coverage ratio. You know what is the formula for ICR? The formula for ICR is very simple. If you know the formula, you can answer this question very easily, right? Interest coverage ratio. See, the formula for ICR is, let me write it down, right? You must also know it because question is asked based on ICR, right? The formula for ICR is EBIT upon interest expense. EBIT upon interest expense, right? It tells us how many times a company can pay it interest using its profit from the operation. Try to understand. Try to understand what is happening. So this EBIT means what? That the profit that the company generate. And interest expense means what? How many times company can pay it interest using the profit from its operation. That is what this ICR tells us, right? How many times a company can pay it interest using its profit from the operation, right? So how we have to calculate here EBIT? How to calculate EBIT? Can anyone calculate EBIT for me? Please do the calculation. Please tell me, is the formula clear? It tells us how many times a company can pay it interest using profit from its operation. EBIT is what? Profit from its operation in perspective of a company. So can you calculate EBIT? How to calculate the EBIT? Please let me know. It is very simple, right? Let me explain how to calculate the EBIT. Again, I will use that particular pie chart example. Pie chart example is the easiest way to calculate all this kind of thing. So let me again show you how to calculate. So you draw this pie chart, right? So total revenue is 150 crore. Just write here 150, right? And you draw a line like this. So this is your variable cost 90 crore, right? So the remaining is how much? 50 minus 90, and one part of this will be what? One part of this will be our fixed cost, right? One part of this will be our depreciation, and the remaining thing will be our EBIT, right? So how much is the fixed cost? So fixed cost is fixed cost is given 20 crore. How much is the depreciation? Depreciation and amortization is how much? 5 crore, right? So can you tell me what is the EBIT? So just see this particular pie chart, right? And you can easily calculate the EBIT. I'm waiting for your response. Please do the calculation. So out of 150, if you subtract 90, what you will get? See, it is very simple. It is very simple to calculate, it is very simple to calculate this EBIT. Let me explain how to do that. See, 150 minus 90, this will become, 60, further subtract 20, further subtract 5. So this will be how much? This will be, please tell me, is it clear or not? This pie chart example is the best way to calculate EBIT. So 150 minus 90 minus 20 minus 5. So how much you will get? You will get 35 crore. Please tell me, is it clear or not? So this EBIT you get 35 crore, right? And so this is your EBIT. So what is the formula for interest coverage ratio? EBIT upon interest expense. EBIT upon interest expense. How much is the interest expense? Tell me, how much is the interest expense? Yes, very good. 35 crore. Very good. 35 crore. 35 crore is, 35 crore is the EBIT. Very good. Right. So always use this pie chart. This will give you a calculation. Very good. Now friends, can you tell me how much is your interest expense? Please type. I am waiting for your response. How much is the interest expense? So see, two interest they are paying, 6 crore and 2 crore. So the interest expense is how much? 8 crore. Now can you tell me what is the final answer? Can you tell me what is the interest coverage ratio? Yes, they are paying interest on term loan and the company is also paying interest on working capital loan. So how much is the total interest they are paying? Total interest they are paying is 8 crore, right? And how much is the EBIT? EBIT is how much? 35 crore. So now can you tell me what is the interest coverage ratio? Just divide both of them. Just divide both of them. So in the numerator I will write 35 crore. In the denominator I will write 8 crore. So how much you are getting? So I think I'm getting 4.375 times, right? So option number C is the correct answer. So what does it mean? It means that PQR Limited earn enough from its business to pay it interest 4.357 times. That is actually a strong position. It tells the bank that we are financially healthy. Even if the profit drop, we can still pay the interest, right? And this is what bank assess before giving the loan. Please tell me, is the concept clear regarding this interest coverage ratio? How to go about solving a problem based on interest coverage ratio, right? I hope it is clear now, right? Now, suppose ICR is less than 1. Suppose ICR is less than 1, right? What would that mean? Is it a good thing or is it a bad thing? Will bank give the loan or will not bank not give the loan? Type yes if bank give the loan. Type no if the bank will not give the further loan. Suppose ICR is less than 1. What will happen? Type yes if you think that bank will extend further loan and type no if bank will not extend further loan. ICR, interest coverage ratio, right? Just waiting for your response. So basically, if we talk about the ICR, let me just revise what we have discussed. So this EBIT tells us how much a company earned before paying interest and tax. Before paying interest and tax, how much it earned. And interest coverage ratio means EBIT upon interest. So if ICR is less than 1, what does it mean? So it means obviously no. Yes, very good. It means bank will not extend the loan. Why? Because the position is not good for for that particular company, right? Right. That is the point. So higher ICR, it is higher ICR. It means safe for the banker, safe for the bank, and lower ICR means risky borrower, right? Very good. I hope the concept is clear now, right? I hope the concept is clear. What is the significance of ICR? You can understand easily using this example. Now come back to this particular question. Let's come back to this question. Friend, what is happening here? This ABC Limited, they have issued debenture, right? So what is happening here? That is ABC Limited has issued debenture 3 years ago, right? With these terms. So tenor is 7 year, call option after 3 year at the rate 105 per debenture, put option over 5 year at the rate 110 rupees per debenture, right? Now, what is happening? Convertible into equity after 6 years in the ratio 1:10, right? So please read this question carefully because I am going to ask you a question based on them. Again, I am repeating what is happening. ABC Limited issued a series of debenture 3 years ago with the following feature. Tenor was 7 year. Call option after 3 year at the rate 105 per debenture and put option after 5 year at the rate 110 per debenture. And this debenture can be converted into equity after 6 years at a ratio of 1:1. That is one debenture means 10 equity share. Now let's come to the question. What is happening here? That now after 3 years, interest rate in the market have fallen. The prevailing interest rate have dropped, right? Below the rate on this debenture. So the market interest rate has fallen below the coupon rate on the debenture, right? So if the interest rate drop in the market, is it good or bad for the company? Tell me. Type good or type bad? What do you think? So please understand what is happening in the question. Please, I request you. See what is happening. That this company has issued a series of debenture 3 years ago, and the tenor is given, call option, put option. They have exercised. They have taken for hedging purpose, and they have they can convert this debenture into equity after 6 years. But what happened? That what happened just after 3 years. Remember, just after 3 years, what happened? That interest rate in the market have fallen, right? And below the rate on this debenture, you can see the rate on this debenture, right? Interest rate in the market have fallen. So if the interest rate drop in the market, is it good or bad for the company that are paying higher interest? Type good or type bad? What do you think? So Type good or type bad, what do you think? Suppose interest rate drop in the market, is it good or bad? So let me explain what is happening. Suppose you are paying rupees 1000 EMI. Let try to understand what is happening. You are paying rupees 1000 EMI every month on an old loan. You are paying 1000 rupees as EMI on an old loan every month. But now bank are giving loan at lower interest, and your EMI could drop to rupees 800 if you take a new loan. So what would you do? Close the old loan early, or option A, what would you do? Close the old loan. Option B, obviously you will close the old loan, right? And you will take a new cheap loan. You will take a new cheap loan, because in earlier loan you have to pay rupees 1000 as EMI. In the new loan you will have just to pay rupees 800 in the EMI. That is exactly what is happening, what ABC Limited is thinking with this debenture, right? So let's see what are the options. So which of the following strategic action can the company take based on the embedded feature in the debenture? Option A, exercise the put option and force investor to redeem early. Option B, exercise the call option and redeem the debenture early as per agreed price. Option C, convert all debenture into equity immediately to avoid further interest payment. Option D, issue voting right to debenture holder to get approval for early repayment. See what happened, that prevailing interest rate in the market have dropped below the coupon rate of its outstanding debenture. Because you know what is debenture? Yes, obviously it is a bad thing. Yes, it is a bad thing for the company. Very good. You know what is a debenture? Just like it behave like a bond, right? What is happening, that is the coupon rate is higher than the prevailing interest rate, right? So what banks should do? Sorry, what this company should do? That is the point. So option A is saying call option. You know call option, put option. If you know this call option, put option, then only you can answer it, right? So if you know it, the call option, put option, then only you can answer it. So let's understand the option in this debenture. So call option they can exercise after 3 years. You can see it is written, they can exercise the call option after 3 years. What does it mean? it means that it means that the company can call back, right? Company can call back or redeem the debenture before maturity by paying rupees 105 per debenture, right? That is called company can call back. The company can call back or redeeming, either you call it call back or you call it redeem. The company can redeem the debenture before maturity by paying rupees 105 per debenture. And if you talk about the put option, this means investor can force the company to redeem at 110 per debenture. Remember, this put option is available to the investor, and this call option is available to the company. So in under put option, investor can force the company to redeem at 110. And the third option, it have to convert into equity. This means holder can convert debenture into share later at a pre-decided ratio. But what is happening is that interest rate have dropped. So what should company do? So the correct answer to this question is option number B, right? Why? Because interest rate are low in the market. So the company can redeem debenture early using the call option at rupees 105, and they can save on the high interest cost, right? And they can reissue the new debenture at lower rate, right? Since the market rate is lower and company is paying higher to the debenture holder, so what it will do, it will exercise the call option, it will redeem all the debenture, it will pay at rupees 105 per debenture, right? And they will reissue, right? You know call option, put option. Please tell me if it is not clear, then I will explain. Option B is the correct answer, right? That it will exercise the call option. You know what is call option? We have discussed in BFM. You know call option means what? Call option means the issuer right to take back early. Those who have issued the option, they have the right to take back early. They can call back. They can call back early, right? They take back early. That is the issuer right to take back early. Then what is put option? Put option is what? Investor right to return it early, right? Suppose investor decided that no, I want my money back. I want my money back. Take your debenture and give me money. That is called put option. And company said to investor, okay, what I am doing, that whatever debenture I have given you, I'm returning the money and give back my debenture, right? So that is the call option. And convertible debenture, you know what is happening? That debenture is converted into equity, that becomes share later, right? Why the company we use call option? Because to avoid paying higher interest when cheaper fund are available. Suppose coupon rate is suppose 8%, right? Coupon rate is 8% and prevailing market rate is only 6%. So why companies at loss? Why you don't think that companies at loss? Because company is paying 8% coupon to the debenture holder while the market rate is just 6%. So what company will do? It will exercise the call option. it will say to the debenture holder that, I am repaying you, I am redeeming the debenture, I am repaying you, right? And I will repay all the debenture at the rate of 105 rupees, and I will reissue the new debenture at 6% interest rate, which is the market rate, right? So this is the what company will do. Okay, I'm explaining again, right? See what is happening. See, market rate is 6%. I'm taking an example. Suppose market rate is 6% and company debenture rate is 8%, right? So company is at loss because company is paying 8% coupon rate to its debenture holder. So what it decided? They decided to exercise the call option. By exercising the call option, what will happen? That this company, right? So this is the company, right? And these are the holder. What the company will do? This will give the holder the money at rupees 105 per debenture, right? And it will reissue those debenture at 6% interest rate, right? So the company can save a lot of money. Please tell me, is it clear or not, right? So one thing I want to ask you, that who hold the call option? Who hold the call option? Option A, investor. Option B, the company. What do you think? Who hold the call option? Please answer. Right. So this is a very important thing. Question are asked that call option is held by whom? Is it investor hold the call option, or is it the company who hold the call option? Right. The answer is, option B, company. Company can call back the debenture. It can redeem the debenture. My second question is, if the interest rate rise in the market, will the company still use the call option? What do you think? Yes or no? Suppose interest rate rise in the market. Here interest rate decrease. Suppose interest rate rise in the market. Will the company use call option? Yes or no? Will company use call option? Suppose interest rate rise in the market. Will company exercise the call option? What do you think? Yes or no? Obviously no. Why it will use? Because interest rate rise in the market, it will have to pay more interest to the debenture holder. It is paying, suppose, try to understand. This is the logic. Suppose debenture coupon rate is suppose 6% and market interest rate is 8%. So company will, why will exercise call option? It will not exercise the call option because it is paying 6%, which is the beneficial for the company. So remember what we learned from this question is that debenture with embedded future. So these are called debenture with embedded future. Remember, debenture with embedded future give flexibility, right? If the market conditions are right, company can call back the old higher interest rate instrument, they can save the cost, and they can issue newer one at lower rate. Please, if this concept is not crystal clear, please type clear in the chat box. This is very important concept. Based on this question was asked, right? Based on this concept, question was asked that when will company will exercise call option, when will investor will exercise the put option. Sometimes investor can exercise put option also, right? So this concept, now you see the investor case, right? Now one thing we have discussed about the call option which is exercised by the company. Now let's see what investor can do. Let's see this particular question. So ABC Limited issues debenture with this feature, right? Again I told you 7-year maturity, right? Call option after 5 year and put option, call option after 3 year and put option after 5 year. Now imagine you are an investor. Suppose you are an investor. It has been 5 year and you need cash urgently, maybe for a family emergency or a new home or a big wedding. So what you can do? Obviously. So question is, suppose an investor debenture want to exit after 5 year due to personal liquidity issue. Which of the following right or feature can the investor rely upon? Force ABC Limited to convert the debenture to equity immediately. Demand early redemption using the put option. Sell debenture back to the company and under the call option clause. Use voting right at debenture holder to demand early exit. What do you think? Very good. So now answer this question. So if you need money urgently, would you rather sell your debenture to someone else or ask the company to return your money using a legal clause, right? So basically, debenture are like loan you give to a company. Now you want your money back, right? Thankfully. So what do you think? I hope this is clear. Then you can answer this question easily, right? So what are the option? Option A is saying force conversion to equity. So equity conversion is allowed after 6 year only. You see clearly written that conversion to equity, it can happen after 6 year. Clearly written after 6 year, right? So you can't convert into equity after just before the 6 year, right? Option B, put option. Yes, this is what they will use. Put option. Put option. So that is the correct move. right? So debenture are like, loan, right, that you give to the company, right? Now you want your money back. So ABC Limited has given a put option. It's like saying, hey investor, if after 5 years you want to leave, no problem, just ask us to buy it back at rupees 110 per debenture, right? So that is what company is saying to ABC. That is what company is saying to the investor, if you want money after 5 years, no problem, right? Just ask us to buy it back at rupees 110 per debenture. So it is your right as the investor. The company can't say no. That is what we call put option, a pre-agreed exit option for the investor, right? So I hope it is clear now. Please tell me option B is the correct. So what we learned from this discussion is that, call option means, it is the company right. Remember, call option is the right of company, and put option. So put option is the investor right. Put option, is the investor right to get out early, and conversion happen after the timeline. And what is the voting right? You know what is the voting right? So voting right means what? It come after you become a shareholder. Once you become shareholder, in debenture is not a share. Once you become shareholder, then only voting right will come post conversion, right? So please tell me, do debenture holder have voting right before conversion? Please answer. Do debenture holder do debenture holder have voting right before conversion? Yes or no? Do debenture holder have voting right before conversion? Yes or no? What do you think? Just answer it fastly, right? Do debenture holder have voting right before conversion? You know what is voting right? So you can vote, you can have a say in the company decision. That is called voting right, right? So do debenture holder have voting right before conversion? The answer is no, right? Obviously no, right? So I hope it is clear. The concept is clear, right? Main thing is what, conceptual clearance. Once your concept is clear, you can answer any question, right? Very good. Now let's see this particular question. Again a numerical one, right? Again a numerical one. Let's try to answer this question. Let's try to answer it. So the question is, as you can see on your screen, friends, XYZ company has provided this data for the year ending 31st March. Now, sales is given, how much? 84 lakh, right? P by V ratio is given, profit by volume ratio is given 27.55%. Fixed cost excluding interest is 6.96 lakh, and 12% bond 37 lakh. Face value is 1000. Equity capital, equity capital is 50 lakh. Tax rate is 40%. Right, tax rate is 40%. So these are the data which is given, right? So no sir, I'm not getting, concept is not clear. Please tell me, I will again explain. Please tell me whether the previous question concept is clear or not. Put option and call option, company will exercise the call option and investor will exercise the put option. That is the basic point, right? And the third option available is conversion to equity, that, debenture can be converted into equity, right? And that is the third option which can and after you have converted debenture into equity, then only you will get the voting right. That means you have the right to vote, right? Now come back to this question. I will again explain the previous question again. Now listen to this question carefully. This is a very important numerical question, right? So the question is asking you, the data have been given. The question is asking you to calculate the EBIT. You have to calculate the EBIT, right? You know how to calculate the EBIT? You know what is EBIT? Earning before interest and tax. So it is the profit from the regular operation before the company pay interest on the loan and before the tax are deducted, right? So if a company sells a product, earn revenue, subtract all its operating costs like salary, rent, electricity, what is left is EBIT. See what is happening. Suppose company had sold a product. After selling, right? Obviously this will earn revenue. After selling, the company will earn revenue, and from revenue it subtracted all its operating costs, right? Like salary, rent, electricity. What is left is EBIT. You know it very well, right? So how to calculate the EBIT? Just now you remember the pie chart. I told you the pie chart is the most effective way to calculate EBIT. But before that, you must know contribution. How to calculate the contribution? So to calculate the contribution, you will use this profit volume ratio as well as sales, right? So basically, what is contribution? Again, I am drawing this pie chart. This is your total sales. After you have deducted the variable cost, what is remaining is called contribution, right? So contribution is the portion of the sale that is left after variable costs are deducted. So it is the money. This contribution consists of two things: the fixed cost and the profit. So it is the money available to cover the fixed cost and profit, right? So how to calculate the contribution here? So profit by volume ratio is given and sales is given. So what you do, there is a formula which you can use to calculate the contribution. Can anyone calculate contribution for me? What is the contribution in this case? Okay, no connectivity. Okay, again there is issue. So friends, welcome back to the session. I hope everything is okay right now. Now friends, we have to calculate the contribution first. So how to go about calculating the contribution? So the formula is simple. To calculate the contribution, what we need to do? We need to multiply the sale. We need to multiply the sale by P by V ratio. Just multiply the sale by this P by V ratio, right? This formula you have to remember, this profit by volume ratio. If you multiply by the sale, right? I hope everything is okay. I hope everything is okay. I think there was some connectivity issue, right? So just multiply this sale by P by V ratio. How much you are getting as contribution? Please let me know, right? So sales is how much? 84 lakh. 84 lakh is your sales. And what is your P by V? P by V is 27.55%. So how much is 27.55% of 84? Actually, it is 84 lakh, right? Not 84. 84 lakh, right? 27.55%. So how much it is? Please do using calculator, right? Please calculate how much you are getting. 27.55% of 84 lakh. This P by V ratio, profit by volume ratio. So, P by V ratio, what it means, it tells us the profitability of each rupee of sale, right? It tells us profitability of each rupee of sale. Means, for 1 rupee you are selling, how much profit you are getting. That is what this P by V tells you. And, if you multiply the P by V by sale, this will give you the contribution, right? So, volume per profit per unit volume. This means if you are selling 1 unit, how much profit you are generating, right? That is what this P by V ratio is. So if you calculate this 27.55%, you will get 23 lakh 14,200. Please let me know. Are you getting the same? Yes, very good. 23 lakh 14,200. Very good. Now we know the contribution. Now can you calculate the EBIT? Can you calculate the EBIT? How to calculate the EBIT? Again, draw this pie chart. Right. Again, draw this pie chart. This will be super helpful to understand EBIT. Right. So your sales is how much? Your sales is 84 lakh. Your variable cost is how much? Your variable cost, okay, variable cost is not given. Contribution is how much? So this portion, contribution is how much? 23 lakh 14,200, right? 23 lakh 14,200. And this contribution consists of some fixed cost, right? This contribution consists of some fixed cost, and the remaining portion which is left is called EBIT, right? EBIT. So how much is the fixed cost? Fixed cost is 6.96 lakh. 6.96 lakh. So what will our EBIT? What will be our EBIT? EBIT will be how much? It is very simple. 23 lakh 14,200 minus 6 lakh 96,000. Please do the subtraction. How much you are getting? Please do the subtraction. Please tell me, is it clear? Contribution consists of two things. One thing is profit, other thing is fixed cost. Remember it. Remember this diagram. This pie chart is super, super important, right? So we have just calculated the contribution. This profit by volume ratio tells you for 1 unit of the sale, how much you are generating profit. That is called profit by volume ratio. So if you subtract both of them, so options as you can see, which option is correct? 11, 1, 7, 4, 200, right? And so I think I am getting 1618200, right? 16 lakh 18,200. Are you getting the same? Yes, very good. B is the correct answer. 16 lakh 18,200. That is how we get the answer. So let me summarize the fact, what we learned from this question, right? What we learned from this question, this P by V ratio, it tells us profitability of each rupee of sale. And one formula you must keep in your mind, that contribution is multiplication of sale and the profit by volume ratio, and EBIT is equal to contribution minus fixed cost, right? So remember, interest and taxes are handled after EBIT, right? So in this case, as you can see, depreciation calculation has not been included, right? Depreciation calculation has not been included in the EBIT, right? Now let's come back to this particular question. Now again, in the same question, this is the second part of the above question, right? We EBIT, right? And interest on the bond is interest on the bond, you have to calculate the DFL, degree of financial leverage, and options are 1, 1.38, 0.73 and 2. So come back to this question, you have to calculate the degree of financial leverage. We have talked about the degree of financial leverage in the first part of the question. EBIT you have just calculated, it is how much? EBIT is how much? We have just calculated 16,18,200. This is our EBIT. And now you have to calculate DFL. What is the formula for DFL? You remember degree of financial leverage formula, right? We have just talked about degree of financial leverage formula. You remember what is the formula for DFL? It is nothing but EBIT upon EBT, right? So basically EBIT upon EBT. So how to calculate EBT? You know how to calculate EBT? It is very simple. From EBIT you subtract the interest. See, EBIT. See how to calculate EBT? Very simple. You remove this I. You remove this I. This will become EBT. And what is this I? I is interest. So you subtract the interest, you will get EBT. This way you can remember. And how much is the interest? How much is the interest? You can see interest is 12% bond. Face value is 1,000. And the 37 lakh, right? 37 lakh. How much is the interest? Can you calculate the interest? See, basically bond coupon rate is given how much? 12%. Face value is how much? 1,000 rupees is. Basically, bond are issued they have the face value, and 37 lakh. So can you calculate the interest? It is very simple. You calculate 12% of this 37 lakh, isn't it? So if you calculate the 12% of 37 lakh, what will be the answer? Please calculate the interest. So 12 by 100 multiplied by 37 lakh. How much you are getting? Please let me know. Just waiting for your response. 12% of 37 lakh. What will that value will be? So it will be 4 lakh 44,000. Right. That is our interest. So now if you want to calculate EBT, that is earning before tax, which is equal to EBIT minus interest. So what is EBIT? We have just calculated, it is 16,18,200. 16,18,200 minus interest. How much is the interest? 4,44,000. Just subtract it. How much you are getting? 11,74,200. This is our EBT. Please tell me, is it clear? Is it clear till now how we have calculated EBT? Now let's come back to this question. We have to calculate the DFL, right? Options. So now we have calculated EBT. EBT is how much? 11,74,200. And what is EBIT? EBIT we have calculated as 16,18,200. What is our DFL? DFL is the ratio of EBIT upon EBT. So what will that will be? So it will be 16,18,200 divided by 11,74,200. So what value are you getting? Please tell me. Yes, 11,74,200. Very good. That is our EBT. Very good. And now just divide both of them. So after division, it will be near about 1.38. Just now I have calculated. It is near about 1.38. Do you know what is the meaning of this financial leverage? Let me explain. Let me explain a little bit. Suppose a company is doing well and earning good profit, but instead of using it on money, it borrow some to grow faster through bond or through loan. Listen to my word carefully. You will be easily able to understand the financial leverage concept. This is very, very important. Okay. Everyone facing the connection issue? Because on my side everything is okay, right? Please tell me, is connection issue everyone is facing this issue? connection issue? Please let me know. Because I have opened another live session and it is working perfectly. Because most frequently I'm seeing, okay, no, I think there is some network issue, right? Everything is okay, fine. Okay, now friends, listen to my word carefully, that what is financial leverage all about. See, imagine a company is doing well and earning good profit, but instead of using it on money, it borrows some to grow faster through bond and loan. Now it must pay interest, right? It must pay interest on that borrowed money. So if the company earn well, suppose the company earn well, right? Profit are great. Obviously, the profit are great if it is earn well. But if the earning drop even a little, that fixed interest cost still has to be paid, isn't it? Suppose company don't earn well, this interest the company has to pay, no matter whether it is earning good or earning bad, right? That is where financial leverage comes in. The more borrowed money you use, the more your profits swing up or down due to fixed interest, right? That is what, the more borrowed money you use, the more your profit will swing up or it will go down due to the fixed interest, because interest is fixed no matter the company is earning great, right? See, what I'm talking about, the financial leverage. What is the meaning of financial leverage? Means the more borrowed money the company use, the more your profit will swing up and down due to the fixed interest part, right? So that is how. So answer to this question is 1.38, right? And one thing you must note it down, that if DFL is greater than 1, right? So one thing you must note it down, that if DFL is greater than 1, it means, company is using the financial leverage and earning are more sensitive to the change in operating profit, right? This means company does have some debt. So 1.38 means what? It means company also does have some debt, right? But it's not too higher. The earning before tax are moderately affected by interest cost. So in simple word, company is using borrowed money, which is helping a bit, but there is some risk involved, right? So one thing I want to tell you, this is very, very important thing. Please remember, see, DFL, degree of financial leverage. It tells us how much the interest cost magnify the profit change. It tells us how much the interest cost magnify the profit change. If it is greater than 1, it means there is a financial leverage. If it is greater than 1, it means there is a financial leverage. And if DFL is higher, it means risk is also higher and reward is also higher. Risk is also higher, reward is also higher. And this 1.38, this is a moderate DFL. This is a moderate DFL. It's called balance. It's called balance. But still risky if earning fall, right? So that is the point. Now, friends, let's look at this particular question. Very good question, right? Let's try to answer it. So, as you can see, we have two scenarios for company. In scenario number 1, EBIT is 1 lakh, tax is 50 lakh, 50,000, profit after tax is 50,000, number of share is 10,000, EPS is 5. In scenario number 2, EBIT is 1.5 lakh, tax is 75,000, profit after tax is 75,000, number of share is 10,000, EPS is 7.5. So the um, question is what is the DFL in this case? So the scenario is for a firm. So what is the DFL in this case? What is the degree of financial leverage in this case? Right. So one thing you can see, right? So you know the formula for DFL? Just now I told you EBIT upon EBT. That is one formula. There is another formula for DFL, right? And there is another formula for calculating the DFL. You know what is that? So DFL tells us how the EPS, which is called earning per share, changes when EBIT, when our operating profit change, right? Try to understand. This is another way to understand the DFL. One formula I already told you, which is EBIT upon EBT. This is another formula, that is percentage change in EPS upon percentage change in EBIT. This is another formula for DFL. It tells us how much the EPS change when EBIT change, right? So if your business has, try to understand this, very, very important. Suppose business has no loan, right? Suppose a business have no loan and business have no interest to pay. Suppose business has not taken any loan and has no interest to pay. What will happen? Any change in EBIT, delta, delta means change. This is a sign of change. Any change in EBIT will directly reflect in change in EPS, right? So because no interest company has to pay, no financial pressure, in that case DFL will be 1. In that case, DFL will be 1. But if the company has to pay interest, even a small change in EBIT would lead to bigger change in EPS. That is called leverage. Now, can you calculate DFL in this case? The formula I have written simple here: percentage change in EPS upon percentage change in EBIT. Please do the calculation. Two scenarios have been given, right? So, as you can see, look at this EPS and look at this EBIT. Look at these two column, right? So earlier EPS was 5, now it increased to 7.5. So how much is the percentage change in EPS? So you know how to calculate percentage change: final value minus initial value upon initial value multiplied by 100. So this will give you percentage change in EPS. How much it is? This is nothing but 2.5 upon 5 into 100. So almost it is 50%. It is 50%. How much is the percentage change in EBIT? You can see earlier it was 1 lakh, later it become 1.5 lakh. So 1.5 lakh minus 1 lakh upon 1 lakh multiplied by 100. How much it is? It is also 50%. Now can you tell me how much is the DFL? Please let me know. How much is the DFL? I am waiting for your response. How much is the DFL? Just apply the formula. Right. Just apply the formula. Percentage change in EPS upon percentage change in EBIT. That is what DFL is. Right. Right. Yes, option B is the correct answer. It will be equal to 1. Very good. It will be equal to 1. Right. So why it is 1? You know why it is 1? Because both are moving in the same way. Right. Because EBIT is growing by 50%, EPS is also growing by 50%. Right. So no interest, no financial leverage, DFL is 1. That is the point. Right. So there are no fixed interest cost. Why it is 1? There is no interest. You see any interest component here? There is no interest cost. And whenever the no interest is there, no financial leverage is there, you need not calculate anything. No need to calculate anything. You can see clearly written here. आप यहाँ पे देखिए. Please see here. Clearly written in the question. The firm has no fixed interest charge. Whenever you see this line, no fixed interest charge, it should strike your mind that no interest the company has to pay. And when no interest it has to pay, it has not taken any loan, it has not taken any bond. That means what? That means, it simply means that it DFL is equal to 1. No need to calculate anything. Remember it? I hope the meaning of DFL is equal to 1 is clear. Please type clear in the chat box if it is clear. No need to calculate anything. Right. If you see this word written, no fixed interest charge, it simply means DFL is equal to 1. Right. Please let me know if it is clear or not. Now friends, let's look at the second question. Now the same scenario, but here is interest involved. Now you see another column for interest here. Right. Now you see another column for interest. This is the very good question. Right. So in the scenario number 1, you can see EBIT is given, interest is given, EBT is given, tax is given, PAT is given, number of share, and EPS is given. Similarly in the scenario number 2. Right. Now the question is, what is DFL and what does it indicate? Right. Very good. It is clear. Now let's try this question. Now we have interest component also. Right. How to find the DFL in this case? How to go about finding the DFL? So in this case, interest is there, means business is borrowing money. And when a business borrow money, it pay fixed interest. Whether profit are high or profit is low, no matter. So imagine you earn more. That means your EBIT increase. So after paying the same fixed interest, your remaining profit increases faster. That is called the leverage, right? So again, we have to apply the same formula for calculating the DFL. So what is the percentage change in EPS? I want everyone to calculate it. It is nothing but 6.5 minus 4 upon 4, right? So how much it is? It is near about 62.5%. And what is percentage change in EBIT? Just use this data. Again, it is 1.5 lakh minus 1 lakh upon 1 lakh. How much it is? I think it is 50%, right? So how much is your DFL? So your DFL is 62.5 divided by 50%. So how much it is? Near about 1.25%, right? So 1.25 means option number A, right? So what is the meaning of this 1.25? You understand? What is the meaning of this 1.25? See, it means that EPS is 25% more sensitive than EBIT. See, EPS upon EBIT. So this 1.25 means that EPS is 1.25 times more sensitive than EBIT. So it means that if your EBIT, try to understand this, very, very important. If your EBIT increased by 10%, if your EBIT increased by 10%, right? EPS will increase by 12.5%. In plain English, it means why? Because of that fixed interest rate, creating leverage. You have taken a loan and that is creating a leverage. And because of that leverage, your EPS is increasing by 12.5%. So the correct answer to this question is option number A, right? So no interest means DFL is equal to 1. Fixed interest, it might be greater than 1 or it might be less than 1, right? I hope it is clear now. I hope it is clear. Please tell me. Now let's see the third part of this question. A firm is operating at the financial break-even point. What will be the DFL? Very good question, right? You know the meaning of break-even? You understand the meaning of break-even? Suppose a firm is operating at the financial break-even. What will be the DFL? Degree of financial leverage. So, financial break-even point means what? It means, no profit is there, no loss is there, right? Again, I come back to this particular diagram. This is your sale, this is your variable cost, right? And what happened at the break-even point? This contribution is of two part. One part is the fixed cost, other part is your profit or your EBIT. But whether you call it profit or you call it EBIT, both means the same. You know what happened in the case of break-even? Break-even means you have no profit. Your no profit is zero, right? Since your profit is zero, that means EBIT is equal to zero, right? So then in that case, what will happen? Your contribution will be equal to fixed cost, right? So EBIT will be zero, the company operating profit. So what is here, the point is, financial break even. What is the meaning of this financial break even? It means, it means the company operating profit, that is EBIT, is exactly equal to the interest cost, is exactly equal to the interest cost, right? So suppose EBIT is 20,000, suppose EBIT is 20,000, so interest cost is also 20,000. Means whatever your profit is there, same is the cost, right? So there is nothing left for the shareholder. For shareholder, there is nothing left, right? Suppose your EBIT, earning before interest and tax, is, see, try to understand this. This is very, very important. So your EBIT, earning before interest and tax, is how much? 20,000. And your interest cost is how much? 20,000. Can you tell me what will be EBT? I am waiting for your response. What will be EBT? Your earning before interest and tax is 20,000. Your interest cost is 20,000. What will be the EBT? Please answer. Obviously, it will be zero. Very good. It will be zero because we subtract EBIT and interest, then we will get EBT. It will be zero. So your EBT is zero. Since your EBT is zero, it means tax, nothing tax is zero, right? PAT is zero, profit after tax is zero. Your EPS is zero, earning per share is zero. Everything is zero. And what is the formula for DFL? What is the formula for DFL? I told you now. The formula for DFL, is percentage change in EPS, right? And upon percentage change in EPS upon percentage change in EBIT. That is what the formula for DFL. So if EPS is zero, right? EPS is zero, so this DFL become undefined because it is in denominator. EPS is the denominator, so DFL become what? Undefined. It is become undefined. So at financial break even point, DFL become undefined. So option D is the correct answer, right? So option D is the correct answer, right? Very good. So let me explain what is happening here. That suppose you run a chai shop. Try to understand using a live example. Suppose you run a chai shop, right? Your rent is rupees 5,000. Suppose you sell enough chai to earn rupees 5,000, right? So what is your profit? Your profit is zero. Now your uncle asks you, how much more profit will you make if you sell 10 more cup? You will say, I don't know yet, because right now you are just breaking even. That is what DFL is like here. You can't calculate it as break even, right? So I hope it is clear. At break even, what is the DFL? It is undefined, right? So remember, at break even, what happened? At break even, your EBIT will become equal to the interest, right? And at BBI and at break even, EBT will become equal to zero. At break even, PAT will become equal to zero. At break even, EPS will become equal to zero, right? And therefore, DFL become what? Undefined. DFL become what? Undefined. Tell me, is it clear? Is it clear? What is this question is most frequently asked regarding if you understand break even clearly or not, or you want me to repeat it again? Please let me paper and calculator with you. because we are going to solve some important numerical from unit 9 and unit number 10. तो आपके पास उम्मीद है पेन पेपर कैलकुलेटर होगा. So let's start with the first question that we have. The first question, as you can see on your screen, let me explain what it is all about. This is the first question of today's session. Let me explain. So friends, in this question, what is given that ABC Limited, right, is considering a project that requires an initial investment of 30,000 rupees. Initial investment required is how much? As you can see, 30,000 rupees, right? And the project generate an annual cash flow of 6,000 for 10 years. So it generate annual cash flow of 6,000 for 10 years. And company use a 15% discount rate to evaluate the project, right? As you can see, the same thing has been shown in the form of in the form of table. So these are the cash flow. First year it will receive 6,000, second year also 6,000, third year 6,000, till 10 year it will receive 6,000. And then we find the present value factor, we multiply both of them to get the present value, and then we get the cumulative PPV. So this is just a table given for your convenience. Now the question is, which of the following statement is correct about the project payback period? Very good question, right? Which statement is correct regarding the project payback period? That is what has been asked. So option number A, the simple payback period is 10 years, matching the discounted payback period. Option B, the discounted payback period is 5 years and it ignores the time value of money. The simple payback period is 5 years, but the discounted payback period is 10 years due to 15% discount rate. Option number D, both payback methods show 3 years as the project recover cost early. So this question checks your concept regarding simple payback and discounted payback. So you have to find what is the simple payback period and what is the discounted payback period, right? We have discussed this payback period in the last lecture. So do you know how to go about solving this question? So what is the meaning of simple payback period? Let me explain. What is the meaning of simple payback period? It is just how long it takes to recover the initial investment. How long it takes to recover the initial investment, right? That is called simple payback period, initial investment. So we ignore any time value of money in the simple payback period. So can you tell me what will be the payback period as per the simple? What will be the payback period? We have discussed in the last lecture. Just let me know in the chat box. What will be the simple payback period? Just let me know. Very simple, very easy, right? How to find simple payback period? In the numerator, you write the initial investment. In the numerator, you write the initial investment. In the denominator, you write the cash inflow. And just divide both of them, you will get the simple payback period. So please tell me how much it is. Any response from your side? How much is the simple payback period? It is nothing. What is the initial investment? What is the initial investment here? So in this case, the initial investment is, as you can see, 30,000, right? Initial investment is 30,000. Annual cash flow is 6,000, right? So divide both of them, you will get what? You will get 5, right? So this 5 is what? 5 is a simple payback period, 5 years. So this 5 year is the simple payback period. Please let me know. I'm not getting any response. I think you know it, right? I think you know how to calculate the simple payback period. So just you have to divide the initial investment by the cash inflow. So this 5 year is what we call the simple payback period. Now come back to the discounted payback period, right? This one is new. Let me explain how to find the discounted payback period. If you have any doubt anywhere, please let me know, right? So if we talk about the discounted payback period, it is little different. The demerit of simple payback period was that it does not take time value of money into consideration. But if we talk about this discounted payback period, let me write it down. Discounted payback period method, it takes time value into consideration. It takes the time value of money, right? Time value of money. It means that future cash inflow are worth less than cash inflow today. So we need to discount. And what is the discounting rate? 15%. And that is what has been done in this particular table, right? In this particular table, as you can see, the same thing has been done. Very good morning to all of you. So this is our first question of today's session. Let me again, for those people who have joined late, right? Let me again read the question. What this question is all about. See, what is happening in this case, that a project require initial investment of rupees 30,000. It generate an annual cash inflow of 6,000 for 10 years, right? And company use a 15% discount rate, right? And this table has been given for your convenience. In this table, you can see there are 10 years, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. The second column shows you the cash flow, right? Cash flow means The how much is the cash inflow? 6,000 every year. First year 6,000 you get, second year 6,000 you get, third year 6,000 you get, and you have invested 30,000, and 10th year also 6,000. Then we have the present value factor. You know what is present value factor? It is nothing but 1 upon 1 plus r whole to the power n. So what is r here? R is a discounting factor. So 1 upon 1 plus 0.15. And what is n? So for first year n is equal to 1, for second year n is equal to 2, for third year n is equal to 3. That's why you see this value. And you know, when we multiply this cash flow with their respective present value factor, you will get the present value, right? You will get the present value. So what we have done, we have multiplied this, so we get this. Multiply this, so we get this. Multiply this, so we get. And finally, we find a cumulative PV. Now the question is, which of the following statement is correct? Again, I'm repeating because some people have joined late. So option number A, simple payback period is 10 year, discounted payback period is 5 year. Option C, simple payback period is 5 year, but discounted payback period is 10 year. And option number D, both payback periods shows 3 year. At the project recover cost early. So in the last lecture, I told you how to find the simple payback period. If you remember, it is very simple because you know simple payback period does not take time value of money into consideration, right? It does not take time value of money. So if you want to find the simple payback period, just write the initial investment in the numerator, and just write the cash inflow in the denominator. Right, you did not take time value of money into consideration. What is the initial investment? 30,000. Just write 30,000 in the numerator. And what is the cash inflow? 6,000. Just write 6,000 in the denominator. How much it is? 5 year. So as per the simple payback period method, simple payback period is how much? 5 year. Right. Now come back to discounted payback period. There are two kinds of payback period, you know, simple payback period and discounted payback period. Now let's calculate the discounted payback period. Right. Simple payback means what? How much time it will take to recover your initial money. So you have invested 30,000 and every month, every year you are getting 6,000. So obviously it will take 5 years to recover the entire money back. That is called simple payback period method. But if you talk about the discounted payback period method, you know, it takes time value of money into consideration, right? If you talk about discounted PP means payback period, it takes time value of money into consideration. You know what is the meaning of time value of money? It says that future cash flow are worth less than cash flow today. And what is the discounting factor? 15%. So you can see we have already find the PVF for you. PVF we have already find, and cumulative we have also find. Now can you tell me what will be the discounted payback period method? As you can see, cumulative is almost 30,114. So can you tell me what will be the discounted payback period method? The discounted payback period, as you can see, the cumulative PV is 30,114. So let's go through the options. The option number 1 says that 10 years. Simple payback period is 10 years. So this is incorrect. Why? Because simple payback period is 5 years. What about option B? So because you know, in this case, what it is happening. So can you tell me what is the discounted payback period method based on this particular table? I have drawn this table for you. In examination, it might not be given, right? So I have drawn this table for calculating the cumulative cash flow, cumulative present value. So can you tell me how much time it is taking to recover the entire 30,000 amount? See, in first year we have recovered just 5,220. In second year we have recovered the 9,756, and so on. In the 10th year we have recovered 30,114. So can you tell me what is the discounted payback period? Just tell me. Let me know whether your concept is clear or not regarding. I told you now. What is the meaning of payback period? How much time it will take to recover the initial invested amount? So you have invested 30,000. How much time it will take, as per discounted payback period method, to recover that amount? Tell me how much time it is taking. 10 year. Very good. It is taking 10 year. As you can see, in the 10th year, our cumulative is 30,114. Right. So the correct answer to this question is option number C. Right. So because you know, after the 10th year, the cumulative PV is 30,114, which exceed the 30,000. Right. So this is the initial investment. So it takes about 10 years to fully recover the amount. Exact is not 10 year, 10 point something something, but we can call it 10 year. Right. So simple payback period is 5 year and discounted payback is 10 year. So what we learn from this question, you know, see how to go about finding the discounted payback period method. You have to draw this table. Remember, this table will not be given in the examination. Sometimes you have to draw it yourself, right? I have given this just for your convenience. In the examination, this table will not be given. So what you will do, you will draw 5 column: year, cash flow, PVF, PV, and cumulative PV. This 5 column you will draw. In the first column, you will write the year. How many years are there? 10 years are there. So just write 1, 2, 3, 4 till 10. Then you will write the annual cash flow. So it is a uniform annual cash flow, 6,000 every year, 6,000, 6,000. Then you will find the present value factor. How to find the present value factor? 1 upon 1 plus r whole to the power n. R in this case is discounting factor, which is 15%. And what is n? N varies. N is the number of year. So for n is equal to 1, just put the value and get the result. You will get 0.870. For n is equal to 2, you will get 0.756. So this will give you present value factor, PVF. Now what you do? You multiply the cash flow with PVF to get the PV. Similarly, cash flow with PVF to get the PV. And I think you know how to find the cumulative PV. Very easy. You just add both of them, and finally cumulative PV you are getting this much. Is it clear? Please tell me. So what we learned from this question is that simple payback period is quite efficient and easy to calculate, but discounted payback period method consider the time value of money, right? So I hope it is clear now. Let's come back to the next question, right? So this is our next question. This is the explanation part. Yes. So this is the question. Let me zoom a little bit so that the question is clearly visible to you. Let's see what question is asking. So friends, the question is Take a Style. Take a Style is a fashion retail company, right? It is a fashion retail company. It is evaluating a new project. Fine. They estimate revenue. They estimate expenses, and over the next 3 years, they estimate revenue and expense over the next 3 years, right? To determine if the project is worth investing in. To determine the project viability. Viability means if the project is worth investing in. They prefer using methods, right, that are based on accounting information, right, that is easy to access and familiar to the business world, rather than relying on the long-term cash flow projection. So that is the question. So which of the following statement best describe a key characteristics of the accounting rate of return method that make it appealing to Take a Style, but also highlight a significant limitation? So this question is about ARR. ARR, accounting rate of return. Option A, ARR consider the time value of money and relies on complex cash flow forecast, making it suitable for long-term project. Option B, ARR is profit-centric, use readily available accounting data, and is easy to understand, but it ignores the time value of money. Option C, ARR is cash flow centric, consider the time value of money, and require estimate only for the first year. And the option number D, ARR relies on detailed market analysis, provide a precise rate of return, and account for all possible risks. So this question is about accounting rate of return. If you know it, you can answer it clearly, right? Accounting rate of return. What is accounting rate of return? Let me explain. So basically, this is a method. If you talk about the accounting rate of return, this is a kind of method, right? That measures the average accounting profit. What it measures? It measures the average accounting profit, right? It measures the average accounting profit from a project related to the initial investment. It measures the average accounting profit from a project related to the initial investment. Simply, you can say it tells you how much profit a company expects to make from a project every year compared to what it invested in the project. Try to understand it. See, on one part you have the investment that the company has invested. On the other part you have the profit. So basically it compare investment as well as profit. It says that it tells you how much profit a company expect to make from a project every year. How much profit a company expect to make from a project every year compared to what it invested initially. Now what is happening here? There is a company called Take a Style. As you can see, this Take a Style company. This Take a Style like the method, right? You can see this Take a Style is preferring the method called ARR. Why it is preferring the method called ARR? Because the reason is because profit, right? The reason is profit. So can you tell me why ARR, why this Take a Style is preferring this ARR method or accounting rate of return method? Because accounting rate of return method, right, is based on profit. It is based on profit, right? Like your which is readily available. This profit, this profit you can get from your financial statement. From your financial statement you can easily get the profit, right? And also it uses the average. It uses the average annual profit. What it use? It use the average annual profit. We will do one numerical based on it in the upcoming slide, but this is the theoretical question. This question is about what are the benefits of ARR and what are the limitation of ARR. So two things. First thing is that it use profit, which is readily available in the financial statement. And second thing is that, it uses the average annual profit over the life of project. And so what is the formula for calculating ARR? It is very simple. In the numerator, you write the average annual profit, and in the denominator, you write the initial investment. This is how we calculate ARR, accounting rate of return, average annual profit upon initial investment. Now, can you tell me the answer? What is the key characteristics of ARR and what is the limitation of ARR? One question, both have been given, limitation as well as characteristics. Can you tell me the answer of this? So take a style like ARR method because it is simple, quick, and uses information that is already available in the company financial statement. Because in the company financial statement, profit is available, profit data is available, right? But there is a limitation also. There is a limitation of this method also. What is the limitation? It does not takes into account time value of money. Remember, time value of money, it does not takes into account. You know what is the meaning of time value of money? That means it does not take into account that money today is worth more than money tomorrow, right? So let me give you one example. For example, suppose a project generate a lot of profit. Suppose a project generate lot of profit in the latter year. In the latter year, suppose the project generate a lot of profit, right? So the ARR method treats it the same as profit generated in the first year. That is the demerit of this ARR. It does not take time value of money into consideration. Suppose a project generates lot of profit in the latter part of the year, right? So the ARR method treats it the same as the profit generated in the first year. So what do you think? So because time value of money is very crucial, because money received sooner is more valuable than the same amount that you receive later, right? So let's go through option. Any answer from your side? Which option do you think is correct? Any answer about ARR? Right. What do you think is the correct answer here? Which option do you think is correct? So let me explain. Let me go option by option. Option number A, it says that ARR consider the time value of money. Do you think it is correct? No. ARR does not consider time value of money. This is incorrect. So option number A, option number A is incorrect. What about option number B? ARR is profit centric, uses readily available accounting data, and is easy to understand, but it ignores the time value of money. Exactly. This is the correct answer. Because ARR focus on profit. You know the formula? The formula is average annual profit. In the numerator, we write average annual profit. In the denominator, we write initial investment. This is how we calculate ARR. What is ARR? ARR means accounting rate of return, right? So option B is the correct. It is profit centric. It uses readily available data, easy to understand. What about option C? ARR is cash flow centric. This is wrong because ARR is not focused on cash flow. It's about profit, right? Rate of return is profit. It's about profit. And option D, ARR relies on detailed market analysis. This is also incorrect. Why? Because ARR use accounting data. It does not use detailed market analysis, and it does not account for all this. Please tell me, is it clear or not? Or do you want me to explain it again? Please let me know. Yes, B is the correct answer. I hope the concept is clear regarding the ARR. What is the merit and what is the demerit of accounting rate of return? In examination, what happened that they ask you some questions like limitations and merits of ARR. So what we learn from this question, what is learning from this question, that ARR is simple, accounting rate of return method is simple, it is profit based, that is easy to calculate. However, ARR ignore the time value of money, which make it less accurate for evaluating long term project. So please tell me, would you prefer ARR for long term project, yes or no? Please tell me. This is a very good question. क्या आप accounting rate of return method को long term project के लिए prefer करेंगे? Yes or no? Please type in the chat box. Would you prefer accounting rate of return method for long term project? What do you think? Yes or no? So the answer is no. You will not prefer it. आप नहीं prefer करेंगे. Why? Because long term, because ARR does not take time value of money into consideration, right? ARR, accounting rate of return, ignores the time value of money, which make it less accurate for evaluating long term project. And it is very good for a company like TechStyle. For this type of company called TechStyle, it is very good method. It is very perfect method because it is a simple method based on the available data, but is not ideal for project that has spent many years or have cash inflow that come later, right? I hope that is clear now. Now, friends, let's come back to this question. Now this is a numerical based question based on ARR. I hope everyone has pen, paper and calculator. सभी के पास पेन पेपर कैलकुलेटर होना चाहिए, तभी जाके इस क्वेश्चन को आप सॉल्व कर पाएंगे. आइए देखते हैं इस क्वेश्चन को. So what the question is asking, there is a scenario presented before you. The question is, that A Investment Limited, A Limited, they invested 3 lakh rupees in a project that has 3-year lifetime and salvage value of rupees 90,000. Annual profit before depreciation is 1,50,000 and depreciation is 70,000 rupees per year. So, there are 3 methods of calculating ARR: version 1, version 2, version 3. So, version 1 is about annual basis. So, using annual basis of ARR, what is the ARR for year number 3? So, this is what you have to calculate. You have to calculate the accounting rate of return for year number 3. So, just now I told you the formula. In the previous slide, I told you the formula of ARR. Let me again write down the formula. I am writing the formula of ARR here. So the formula of ARR is profit before depreciation. Profit before depreciation divided by investment at the beginning of year. Investment at beginning multiplied by 100. Right? Sorry, profit before or profit after. Just wait a minute. There is a mistake. Profit after, not profit before. Profit after depreciation. Right? Divided by investment at the beginning multiplied by 100, because ARR takes profit into consideration. In the case of payback period method, in place of profit, we take what? We take investment divided by cash flow. But here we are taking profit. Right? Now you have to apply this formula to calculate the ARR. So can you calculate it for me? How much value you are getting? So write profit after depreciation in the numerator, investment at the beginning in denominator. So what does that mean? That let's break down into 2 parts. The first part is profit after depreciation. So this is the annual profit that we account for after we account for depreciation. Depreciation is a kind of non-cash expense. I told you early in the last lecture, depreciation is a kind of non-cash expense that reduce the value of project over the time. And in the denominator, we have the investment at the beginning. So what is the meaning of investment at the beginning? This is the value of the project at the start of that year. Right? At the start of that year, the value of project is called, investment at the beginning. Right? So how to calculate the investment? See, investment at the beginning of year, and you have to calculate for year number 3. You can see you have to calculate the ARR for year number 3. So how to calculate the ARR for year number 3? So there is a formula. Sorry, how to calculate the investment at the beginning of? Can you tell me what is the investment at the beginning of 3rd year? So what you have to do? You have to find the initial investment, and you have to subtract the depreciation accumulated until that point. Then you will get investment at the beginning of the year. Right? So in initial investment, subtract the depreciation accumulated. Right? And this is how you calculate the investment at the beginning of the year. Now, in year number 3, come back to the question. In year number 3, what are the data available? So annual profit before depreciation is how much? 1,50,000. Annual depreciation is 70,000. And can you calculate me what is the initial investment at the beginning of year number 3? Can you calculate? Can you write the value in the chat box? What is the initial investment at the beginning of year number 3? Just waiting for your response. If you know the concept of depreciation, you can easily tell me. Can you tell me what is the initial investment at the beginning of year number 3? So let me explain. See, very easy. Initial investment was 33 lakh, right? 3 lakh. After 1 year, it is a straight line method. So it get depreciated. So one way you can think of like this: total year is how much? 3 year, right? And what is the salvage value? Salvage value is 90,000. So just add 90,000 plus 70,000. This is the initial investment at the beginning of year number 3, which is how much? 1,60,000. Right? Is it clear or not? Please tell me. Why we have added the salvage value to the depreciation? Because this is a kind of a straight line method. The depreciation, this particular project is depreciating in uniformly every year. It is depreciating by 70,000. You have to calculate what is the initial investment at the beginning of year number 3. So what we did, we started from the last, that is the salvage value. which is 90,000, and we added the depreciation over year number 3, which is 70,000, and we get the investment at the beginning of year number 3. Please tell me, is it clear or not? If it is not clear, I will explain it again, because this is the main thing that you have to take into consideration initial investment at the beginning of the year, right? So since depreciation reduces the value of project, so that is why initial investment at the beginning of year is 1,60,000. Now let's calculate the step by step, right? What is the profit after depreciation? Can you tell me what is the numerator? Numerator is profit after depreciation. In short, we write PAD, profit after depreciation. How much you can calculate it? It is nothing but profit before depreciation minus depreciation, right? And what is the profit before depreciation? You can see 1,50,000. 1,50,000. And what is depreciation? 70,000, right? So just subtract 70,000 from 1,50,000. How much is the profit after depreciation? It is 80,000, right? So we have profit after depreciation and we have initial investment at the beginning of 3 years. Okay, not clear. Okay, fine. Let me explain. See what is happening here. See, main thing is initial investment at the beginning of 3 years. See, let me explain. See what is happening here. See, so initially how much invested? 3 lakh, right? And after at the this is year number 1, this is year number 1. So after, how much is the depreciation? 70,000 is the depreciation, right, for the year number 1. So how much will the value be? Just subtract the 70,000 from 3 lakh, it will be 2,30,000. I'm just explaining why we get the initial investment as 1,60,000. Now year number 2, how much is the depreciation? 70,000. Just subtract the 70,000. How much it is? 1,60,000. So you can see at the end of year number 2, the investment value is 1,60,000. Or we can also call it at the beginning of year number 3, the investment value is 1,60,000. Now is it clear why we have taken 1,60,000? Another way to do it, we start from the last. So in the last, what we get? The salvage value. What is the salvage value? In the question it is given. Salvage value is how much? 90,000. Right. The salvage value is 90,000, which means the residual value is 90,000. And how many year? 3 year. So in the third year, it would have depreciated by 70,000. We just add, right? You will get 1,60,000. So either you come down or you go up. Both will give you the same result. 1,60,000 investment at the beginning of 3 year. Please tell me, is it clear now? Please tell me. See, we are just applying the concept of depreciation. Nothing, no any rocket science. Very easy to understand. We are just depreciating the project value by 70,000 every year, and you have to calculate what is the project value at the beginning of 3 years. Right? Either you move top down or you move bottom up. Right? You will get the same result. Very good. So now, very good. Now let's come back to this question. So I think PAD you can easily calculate it. Profit before depreciation minus depreciation. So what is profit before depreciation? 1,50,000 minus 70,000. So it is how much? 80,000, right? Now just apply the formula. In the numerator, you write what? In the numerator, you will write the profit after depreciation, which is 80,000, and divided by 1,60,000. So how much is the answer? Can you tell me what is the answer? It is 50%, right? So the answer is option number C, right? Is it clear or not? Please let me know. This concept is very, very important. No, it is C, because profit after depreciation is profit before depreciation minus depreciation, right? Yes, it is C. Very good. It is C. So is the concept clear? I hope it is clear now, right? How to go about finding the ARR? There are 3 versions on the basis of, this is called annual basis, right? This is called annual basis. Remember the thing which we have discussed now is called the annual basis. I hope it is clear now. The correct answer is 50%. Now, just remember the formula, you can get easily answer it. Now let's look at the second question. The same question, second part. Now using version number 2. What is version number 2? The version number 2 is called the total investment basis, right? It is called the total investment basis. Now you have to calculate the overall ARR for the project. See, in the first question, you were asked to calculate ARR for year number 3, right? See the difference. In this question, what was asked? What you have been asked to calculate the accounting rate of return for year number 3. That is why it is called annual basis. Suppose question asked you to calculate ARR for year number 2, you can calculate it, right? So similarly, but in this case, what is happening? It is our overall ARR for the project. That is called total investment. This is the second version. So you have to calculate the overall ARR. not just particular ARR, overall ARR. So how to go about calculating it? Again, formula remain the same, right? So again, let me come back to this particular question. This is the data. You have to apply this data, right? You have to calculate the overall ARR. So you have to just apply this data to calculate the overall ARR, which is the version 2 of the ARR method. So the key difference between the version 2 is that we treat the total investment as fixed, ignoring the depreciation. We don't take depreciation into account. We take the total investment as fixed, right? That is one of the key difference of the version number 2. So the formula remains the same. What is the formula? To calculate the accounting rate of return, in the numerator we write the average annual profit. Average annual profit. In that case, we were not taking average annual profit, we are just taking the profit. But in this case, we are taking average annual profit, and we will divide by the total initial investment, and multiply it by 100, right? So this is the formula we will use for version number 2. So what is the average annual, what is the average? Oh, one answer I'm getting 34.78. Let me check whether it is correct or not. So can you tell me what is the average annual profit? So the problem tells us that annual profit after depreciation, right? Okay, so annual profit after depreciation is how much? Annual profit after depreciation is 80,000 per year, isn't it? Just subtract these two, 80,000 per year, right? So it means that average annual profit is how much? 80,000, right? And what is the initial investment? 3 lakh. So just write 80,000 in the numerator and just write 3 lakh in the denominator and just multiply it by 100. How much you are getting? Please tell me. See this thing. You have to understand that what is the formula? Average annual profit, because we are taking total investment, right? Since we are taking total investment, so we will write the average annual profit divided by the total investment, right? So average annual profit is how much? 80,000, right? Because the question itself says you, right? Because the question itself says that that profit before depreciation is 1,50,000 and depreciation is 70,000. So profit after depreciation is 80,000. So 80,000 divided by 3 lakh into 100. How much it is? I think you are getting 26.67%. Please let me know. Is it what you are getting? Yes, very good. So the answer to this question is answer to this question is option number A, right? So please tell me, is it clear? So this is called version 2 of ARR. It is calculated using the average annual profit and the total initial investment. We ignore depreciation. In this case, we don't take depreciation into account because we treat the entire investment as constant. Right? So answer is 26.67%. I hope it is clear now. Now, friends, let's take the third version. There are 3 versions of calculating ARR, right? If you have any doubt, any place, please just you can ask for me, because this is an interactive session. The main benefit of this session is that you can ask your doubt, right? I will clear it. So now let's look at the third version of the ARR, that is called average investment basis. Now you have to calculate using version number 3 what is the ARR, right? So again, come back to this question. Let me show you the question. So what is version number 3? It's about average investment basis, right? So let's come back to this question. You have to calculate ARR based on average investment basis. Same question but 3 version, right? How to go about calculating the ARR using the average investment basis? So again, problem is the same, right? Company is investing 3 lakh in a project with 3-year life. Salvage value is given. Annual profit before depreciation is given. And you have to calculate the ARR using average investment. See the wording. Wording is very much important, right? So this version is a bit more realistic than the previous one because it considers the declining value of asset over the time. It takes into account that the project initial investment reduce in value over its life because the company expect to sell for a salvage value at the end. So it use average investment, right? As the name itself suggests, it use average investment over the life of project. How to find the average investment, right? And can you tell me how to find the average investment? So the formula is very simple. To calculate ARR, in the numerator, you will write the average annual profit. But in the denominator, you will write the average investment. That is the difference. In the previous case, we have just taken the total investment. We have not taken the average investment. but since this is average investment, so in the denominator we will take the average investment. So do you know how to go about calculating the average investment? You know how to find the average investment of anything, right? See, it is very simple to understand. You can see that what is our initial investment. Initial investment is what? Initial investment is 3 lakh, right? So initial investment is how much? 3 lakh. This is the initial value. And what is the final value which remains after 3 years, which is called salvage value, which is 90,000. This is the final value which remains, right? So how to find the average investment? Very simple. Average, you know, initial plus final divided by 2. That is how you find the average, right? So average is equal to initial plus final divided by 2. So initial is how much? 3 lakh. Final is how much? 90,000. Divide both by 2. So how much it is? 1,95,000. You know how to find the average, right? So initial investment and the final value that remains, right? That is called salvage value. So that is the point. That is what you have to understand. Plus the salvage value and then divide by 2. You have to get, then you will get the average investment, right? So is it clear now? So average investment is 1,95,000. And what is our numerator? Our numerator is average annual profit. How to find the average annual profit? So you can see annual profit before depreciation is 1,50,000 and depreciation is 70,000. So just subtract both of them. This will give you annual profit after depreciation. How much it is? 80,000. Right? It is 80,000. Is it clear? So it is 80,000. Now friends, in the numerator, we will write 80,000. In the denominator, we will write 1,95,000 multiplied by 100 to get the percentage. Can you tell me what value are you getting? Please let me know what value are you getting. In the numerator, just write 80,000. In the denominator, just write, 1,95,000. So what is the value you are getting? Please let me know. So I am getting, 41.03%. Please tell me, are you getting the same? So 41.03%, right? So this is the value, right? So let me come back to this question. So this is the third question, as you can see. So the answer is 41.03%, right? So this is called ARR value number 3. Average investment basis. So right now, let's summarize the learning from the 3 ARR, right? So this is the summary. There are 3 versions of calculating the ARR. Yes, very good. So version number 1, which is annual basis. What we did in the let me again write on the formula. How did we calculate the ARR based on version number 1? That is on annual basis. What was the formula which were used? You remember the formula? In the case of ARR number 1, in a particular year, it shows the yearly performance, right? It will ask you to calculate what is the ARR over year 2, what is ARR over year 1, what is ARR over year 3. That is called yearly performance. So that is what we write profit after depreciation in the numerator, and we write the initial investment at the beginning of the year, right? Initial investment at the beginning of year, at beginning into 100. This is what we use to calculate version number 1. Version number 2 is about the total investment. How did we calculate? We write the average annual profit. We write the average annual profit and we divide by the initial investment, total investment. Total investment. It is simpler but less accurate because it ignores the depreciation multiplied by 100. This is the version number 2. And version number 3, just now we have seen in the numerator, we write average annual profit. And in the denominator, what we do, we write average investment and multiply it by 100. So it is more balanced. It considers the asset value reduction. So these are the summary of the 3 versions which we have just discussed. Please tell me, is this 3 version clear? Because question will be asked. One case study is asked every year from this ARR, accounting rate of return. It checks your understanding. Whenever 1 year ARR is asked for year number 1, year number 2, year number 3, go for version number 1. Whenever average investment is asked, then go for version number 3, right? And whenever that total based on total investment is asked, go for version number 2. So just one case study. I hope it is clear. Very good. Now friends, one question for you, right? Let me give you one question to solve. Now this question you try yourself, right? Let me check where your understanding, how much you have understand a company. So let me check your understanding. So the question is, a company invest 10 lakh in a project and earn total profit after tax and depreciation of 4,60,000 over 5 years. The salvage value of machinery at the end of 5 years is 80,000. So what is ARR if calculated using the initial investment method, right? So what is ARR if calculated using the initial? So just now I told you three methods: annual basis, total investment, average investment. Right. So now please tell how to go about calculating it. So please try this question on your own. I'm just giving you 1 minute, and then I will explain. Right. Okay, fine. Sufficient time. I think you might have calculated it. Let me explain how to find ARR for this method. Okay, so one answer I'm getting A. Let me explain. See what we have to do in this case. Initial investment, right? So so we have to take initial investment. What is the formula we have to use? We will write the average annual profit. Average annual profit. We divide it by the initial investment. Sorry for my handwriting. Just understand initial investment multiplied by 100, right? So this is how we calculate the ARR, accounting rate of return. Now what is important to note is that this method does not consider things like time value of money or the salvage value of machinery, right? So now let's calculate the average annual profit. What is the average annual profit? So total profit after tax and depreciation is given 4,60,000 over 5 years, right? So this is total depreciation, total PAD for 5 years. So what is the average annual profit? It is nothing but 4,60,000 divided by 5, because this is our total 5 year. So what is our one average? How to find the average for 1 year, right? So basically divided by 5. So how much it is? 92,000. So your average annual profit is, I hope everyone have calculated, because once you solve yourself and then see the explanation, this is the best way of learning. If you don't solve it, then you will not understand it, because numerical question can be best understood if you solve it first yourself. That is why I give you time to calculate it, so you will know your mistake from what went wrong, and you will not commit the same mistake in the examination, right? So let's come back to this question. So 4,60,000, which is our total profit, just divided by 5, this will give you the average, which is how much? 92,000. I hope that makes sense to you. We are just taking the total profit and dividing it by the number of year to get the average profit per year. Right. Now we have to calculate the ARR. Initial investment is given 10 lakh. Just apply the formula. In the numerator, we will write 92,000. In the denominator, we will write 10 lakh and just multiply it by 100. Very good. One answer I have got, 9.2%. Very good. Excellent. Right. I hope it is clear now. 9.2% is the answer. I hope everyone is getting 9.2. Very good to see that all of you have understood. Right. So this is our version number 2. This is our version number 2. Right. ARR, I hope the concept is clear now. If any doubt, please raise the question. I hope it is clear. Very easy to understand this ARR concept. Now friends, let's try this one. The same company now want to compute ARR using average investment, which consider the salvage value of 80,000. So what is the ARR using average investment? Please tell me. Just giving you 1 minute to solve. So using average investment, the same company want to compute ARR. Salvage value is 80,000. What is ARR using average investment? Let's come back to this data. This is the data. And salvage value they have given 80,000, right? They want to calculate using average investment method. Can you do the calculation? How much percentage you are getting using average investment method? Okay, so let me explain how to go about calculating it, the average using the average investment method. So basically in this case what will happen, that our average annual profit will remain the same, right? Which is how much? 92,000. Just now we have calculated. Average annual profit is remain the same, which is 92,000. But but in this case, see, I think there is one thing. I think there one mistake we have done in the previous question. Let me explain that. I have wrongly calculated the average, right? So what is the exact formula to calculate the average? Let me explain. See, how to go about calculating the average. I think one mistake I have done in the previous case. Let me correct that mistake here. See, whenever we want to calculate the average in this case, see what is happening here. Let me explain using a graph. So using this graph, you can easily understand. See what is happening here. So this is, this is a linear decrease. Initial value is how much? Initial value, this please try to understand this thing. Very, very important. So initial value is how much? 10 lakh, right? So just let me down 10 lakh, right? Let me write it down there, 10 lakh. And what is the final value? There is one mistake we have done in the last question. I'm just correcting it. And the final value is 80,000. This is the final value. And we want to calculate the average, right? We want to calculate the average. Do you know how to calculate the average of this? So basically using the graph, you can easily understand it. So let me use this particular space to make you clear, right? How to find the average of this case, right? Because we have to calculate average investment, right? So graphical way is the best way to understand it. So suppose this is the graph, right? Initial value is how much? 10 lakh. Final value is how much? Somewhere here 80,000, 80K, right? We have to find the average. So we have to find middle point. What is the middle point, right? And this one, suppose this is the middle point, suppose this is X, this is middle point, this is what we are interested in finding, right? So how to find the middle point? It is very simple. Please try to understand how to find the middle point. First of all, what we will do, see this middle point, right? This middle point will be somewhere middle of this 10 lakh and 80,000, right? So this is somewhere middle of it, 10 lakh and 80,000, right? So what we will do, this one is, so right, see what is happening here. This one is okay, let me erase it. Because in the book, they have directly given you the formula, but I'm explaining why that formula came. Because once you understand the reason behind that formula, you can easily understand. So this one is how much? 10 lakh. This height, which I have drawn by red color. And this one is how much? 80K, right? 80,000, right? So how much is this much? Let me use different color, right? How much is this much? I'm using the green color. How much is this? It is nothing but 10 lakh minus 80,000, isn't it? Which I have drawn by green color. 10 lakh minus 80,000. And the midpoint of it. This is the midpoint. So you just divide it by 2, right? So 10 lakh minus 80,000 divided by 2. This is the midpoint, right? So how much it is? Just calculate. 10 lakh minus 80,000. It is 9 lakh, 9 lakh 20,000. There is one mistake which we have done in the previous question. I am correcting it. So 9 lakh 20,000 divided by 2. How much it is? It is, 4 lakh 60,000. 4 lakh 60,000, right? So basically what is this, that this much height, try to understand this, very, very important. This much height is how much? 4 lakh 60,000. But we are interested in this much. So what we need to do, we need to add this one, right? We need to add this one, and this one is how much? 80,000. So this plus this is equal to this. So 4 lakh 60,000 plus 80,000, this will give you what? 5 lakh 40,000. And this is our average investment. The answer is 5 lakh 40,000 is the average investment. I think one mistake was there in the previous question, right? That is what I'm telling you. In your book, they have written down the formula like this: half of 10 lakh minus 80,000 and plus 80,000. This formula they have given, right? How did we get this formula? That is what I have explained using this graph. So this is the average investment. So this is how much? 9 lakh 20,000 divided by 2 plus 80,000. So it is how much? 4 lakh 60,000 plus 80,000. It is how much? 5 lakh 40,000. So this is your average investment, right? And what is your average profit? Average profit is 92,000, I think. Yes. So 92,000 divided by 5 lakh 40,000 multiplied by 100, right? So how much it is? 17.04%. Yeah, 17.04% is the correct answer, right? The previous question, it was some mistake. I will again correct it, right? So this is how this formula you have to use, right? So whenever you want to find the average investment, suppose initially they have invested I1, right? And the salvage value is suppose I2. So half of I1 minus I2 plus I2, right? This is the average investment formula. This is how you will calculate the average investment. And this thing, why this formula? So this can be easily understood using this particular graph, right? The graph which I have drawn here. So no need to go into that deep. Just remember this formula, right? You will that will be enough. So whenever you have to find the average investment, just apply this formula. Half of I1 minus I2 plus I2. What is I1? I1 is the initial investment. What is I2? I2 is the salvage value, right? And that is all. That will work. Okay. Now, friends, let's see the next one. So this is one question, right? Let's come back to this question. What is happening here? That Jeta Corp, right? So basically, in this question, you can see Jeta Corporation is evaluating a weird project, unconventional project, right? With the cash flow pattern, you can see first year they are getting they are losing 100. Suppose it is crore, right? All data in crores. I mean, sorry, in $1,000,000. So first year they are losing $100 million in the 0 year. Means they have invested, right? They have invested $100 million. You know what is the meaning of this zero? Negative. Negative means the cash is going out of the company. So it means they have invested this, right? In the first year the cash inflow is $320 million. In the second year they are losing this much. In the third year they are getting this much, right? So it start negative, then jump to positive, and then dip negative again, right? Then what happened? The finance team calculate the project IRR, IRR, internal rate of return, right? And got two answer. They got two answer. The first answer they got 15%, and the second answer they got 40%. They are getting two internal rate of return, right? But when they calculated NPV, you know what is NPV? NPV means net present value, right? So when they calculated NPV, right, at 10% WACC, which is called weighted average cost of capital, 10% WACC, right? They got a negative NPV. So question is, what is the most critical limitation of relying solely on IRR for decision making in this scenario? Option A, IRR ignore the project scale. Option B, multiple IRR arise due to non-conventional cash flow. Option C, IRR assume in reinvestment at project rate. And option D, IRR conflict with NPV when cash flow change sign. Right. So basically, question is regarding the limitation of IRR. That is what it asks you. So you know what is the meaning of IRR, internal rate of return? Right. Let me explain. IRR, internal rate of return is the rate at which NPV becomes zero. I think you must have learned this in your AFM, JIB AFM, right? So when net present value you equate to zero, then that rate of return is called IRR, right? So that is exactly what is happening here. See, they are jumping, right? So now you can see earlier it is negative, then it become positive, then again it become negative, then again positive. This is called jumping, right? Moving up, moving down, moving up, moving down. So you can see this cash flow is jumping, right? This is called non-conventional cash flow pattern. What it is called? Non-unconventional cash flow pattern, right? So when this happen, IRR does not give us just one number. Rather, it gives multiple IRR. You see, on one time it is giving you 15%. On one time it is giving you 40%. So they will give you multiple IRR, right? Which is super confusing. You may think, wow, I am getting 40% return, but hold on, your NPV at WACC is 10%, which is destroying the value, which is negative, right? Which is destroying the value. So what do you think the correct answer? What do you think the correct answer? Option number A. So see, option number B, that multiple IRR arise due to non-conventional cash flow complicating interpretation. Most critical limitation of relying solely on IRR, right? IRR can mislead you, right? Option B is a symptom. You see, multiple IRR is a kind of symptom, right? But the real problem is option number D. IRR conflict with NPV when cash flow change sign. IRR can mislead you when it conflict with NPV, especially if cash flow change sign multiple times, right? So that is the limitation of internal rate of return method, right? So the correct answer to this question is option number D. Please let me know, is it clear? So that is one of the critical limitation of this internal rate of return, that it conflict with NPV when cash flow changes the sign. As you can see in this case, sometime it is jumping, sometime it is going down, going up. That's it. So IRR is not always reliable if cash flow are irregular. This is called irregular cash flow. So NPV is your gold standard. It tells you whether value is created at your real cost of capital or not, right? So that is what this question explained. I hope everything is clear. I'm not getting any response. Okay, I'm again explaining. See, what is happening in this case, that cash flow is varying. Sometime it is negative, sometime it is positive, right? So internal rate of return means what? Internal rate of return is a way of calculating the investment return, right? So what you do, you equate NPV to zero. NPV, net present value. NPV is the net present value. How to calculate the NPV? It is nothing but summation of CI upon 1 plus RI to the power n. I is equal to 1 to I is equal to n is equal to 0 minus CI is equal to 0. So we will discuss it later how to calculate the NPV. So you equate NPV to 0, corresponding rate of return is called internal rate of return. What happen whenever in those cases, whenever cash flow changes sign, see, here it is negative, here it is positive, again negative, again positive. In such case, what happen? You will get two IRR, you will get multiple IRR, means more than one IRR, right? You may see that your return is 40%, but actually it is not. So in that case, NPV always gives you the real value. So remember, this is the limitation of internal rate of return, that in unconventional cash flow, internal rate of return does not work, right? Internal rate of return does not work. Rather, we have to rely on NPV, net present value, right? So in the upcoming session, we will discuss that how to find the net present value of a case, because this is super important, right? So I hope the limitation is clear to you, right? So this is the point, that multiple IRR is the symptom. The core issue is IRR potential to mislead, right? So that is the point. Now let's look at this question. This is another question based on the same discussion which we have just done now. So what is happening here, that TakeX Limited is evaluating a project with the following cash flow. Company cost of capital is 100%. We will discuss what is the WACC. I will just discuss in the upcoming lecture. And the project IRR is 25%. But the finance team is concerned that assuming reinvestment as 25% is unrealistic, right? So here you see the cash flow. Again, earlier it was negative, then this is a conventional, not unconventional. This is a conventional cash flow. Means initially you have invested $200 million, and in first year you are getting $150. In second year, this is your cash inflow. In third year, this is your cash inflow. Right. So this is this TakeX Limited evaluating a project. Right. Cost of capital is given. Project IRR is 25%. Internal rate of return is 25%. But the finance team is concerned that assuming reinvestment at 25% is unrealistic, right? So question is, what is the primary advantage of using MIRR? This is called modified internal rate of return, our IRR. One is IRR, internal rate of return, other is MIRR, which is called modified internal rate of return. So option number A, it says that MIRR eliminate multiple IRR issue by adjusting for unconventional cash flow. Option B, MIRR assume reinvestment at the cost of capital, making it more realistic. Option C, MIRR always gives a higher return than IRR. And option D, MIRR ignore the terminal value, simplifying the calculation, right? So this question will tell you what is the advantage of modified internal rate of return over internal rate of return. See, IRR. IRR tells you the rate of return at which your project NPV, at which your project net present value will be equal to 0, right? That rate of return at which your NPV equal to 0, that is called IRR. But IRR quietly assume that every rupee or every dollar you earn get reinvested at the same rate, right? This is one of the assumption of IRR. It assumes that whatever rupee you earn, right? Whatever rupee you earn, right? It get reinvested at the same rate. So suppose IRR is what? 25%. So suppose IRR is 25%, it assumes that you are reinvesting at 25%. It may sound unrealistic because it is unrealistic. In real life, what happened? Company invest at their WACC. Company reinvest at their weighted average cost of capital. What is the WACC? Weighted average cost of capital. How to find it? I will just tell you in the upcoming slide. Right. So what happened in the real life? That company don't invest at 25%. They invest at the weighted average cost of capital. Reinvest, which is how much? 10% here. That is your real world return from the reinvestment. Right. So this is where modified internal rate of return steps in like a hero, right? So it says, let's be practical, let's reinvest at the company cost of capital, not some high dreamy IRR, right? So MIRR say, let's be practical, let's not be unrealistic. What MIRR say, that let's reinvest at the company cost of capital, right? Which is not some high dreamy IRR. This IRR is very high, 25%. So while IRR shows optimistic, it shows an optimistic picture. It shows an optimistic picture, but MIRR gives you a realistic picture, right? So what is the correct answer now? Can you tell me? What is the advantage of MIRR over IRR in this scenario? Option number A, MIRR eliminate the multiple IRR issue by adjusting for unconventional cash flow. No, this is wrong. That is what NPV does. That is done by NPV, net present value, right? So what about option B? MIRR assume reinvestment at the cost of capital. Yes, this is the correct. See, IRR reinvesting at 25% is optimistic. It look optimistic, but it's not realistic. So MIRR say that rate reinvest at the cost of capital, which is 10%, right? We should reinvest at the cost of capital. That is what make it more realistic. Option number C, MIRR always give a high return. No, this is wrong. And MIRR ignore terminal value. No, this is also not wrong. This is also wrong because it takes terminal value into consideration, right? So this is one of the advantage of having MIRR over IRR, right? That is called modified internal rate of return. So it assumes that reinvestment should be at the cost of capital. It should not be at the IRR, right? So that is what it explained regarding the MIRR. Now let's look at one more concept. So till now we have discussed the two limitations of IRR. The first limitation was in the case of unconventional cash flow in the previous question, right? In the case of unconventional cash flow, NPV always work better. And second question we have just discussed that realistic assumption, unrealistic assumption. This is one of the limitations of IRR, right? Now let's look at this particular case. Now let's look at this particular case. Here also you can see the cash flow are, what is happening in this case. As you can see that let's look at a construction project. The cash flow is in $1 million. Initially they have invested $500 million. First year they have got $800 million. Second year 300 minus 300. That is they have their cash outflow. And third year is $200 million. They have get this much. Now this project has two IRR, 12% and 28%, right? And the company finance team is scratching their head, causing confusion, right? But they also calculate the MIRR and they get MIRR at 15% using WACC is equal to 10%. Now the question is, why does MIRR provide a better decision-making tool as compared to IRR? Option number A, MIRR remove ambiguity by providing a single rate. Option B, MIRR always matches NPV, eliminating the conflict in project evaluation. So these are project evaluation technique, NPV, IRR, MIRR. This is way we evaluate the project. Option C, MIRR ignored negative cash flow, simplifying analysis. Option D, MIRR uses a zero discount rate. So question is in which why does MIRR provide a more reliable decision criteria, right? So suppose what is happening here, suppose you are baking a cake. Suppose you are baking a cake. You check two recipe book, right? One say bake for 12 minutes, another say bake for 28 minutes, right? You are confused. Will it be undercooked or burned? That is what happened with the multiple IRR, right? Suppose you are baking a cake. You look two recipe book. One recipe book say that you should bake for 12 minutes. Another recipe book say you should bake for 28 minutes. You are confused that will it be overburned or will it be undercooked, right? So that is what happened with the multiple IRR, right? This IRR can give more than one answer when cash flow changes direction. In this case, you can see initially it is negative, it become positive. Again negative, it become positive. So cash flow is changing the direction, right? So IRR can give more than two values, right? More than one value. So that is where MIRR steps in, like your trusted grandma recipe. MIRR say, don't worry, I have considered everything, inflation, reinvestment, cost, and here is one solid answer you can rely on. So can you tell me what is the main advantage of MIRR? Is it A, B, C or D? Just waiting for your response. What is the main advantage of MIRR? Why MIRR is a more reliable decision criteria? What do you think is the answer of this? I hope I have explained this thing. What is one of the main advantages of MIRR over IRR? Option A, it removes the confusion, that it removes ambiguity. No. Answer is option number A, right? The answer is option number A. MIRR remove ambiguity. It removes the confusion by providing a single rate, unlike multiple IRR, right? This is the correct answer. So IRR can be confusing if cash flow goes up and down, right? So multiple IRR means multiple answer, right? And obviously big confusion. So MIRR just give you one answer, right? It uses cost of capital for reinvestment and discounting, so it is much more practical, right? So it used two things, MIRR used two things. It used WACC, which is weighted average cost of capital, right, and discounting, so it is much more reliable. So always trust MIRR when things get messy. That is the point. Now come back to this question. Now this one is a little different. Here you have to calculate the profitability index, right? So we have discussed what is MIRR, what is IRR, what is the advantage of MIRR over IRR, and what is why NPV, net present value, they have a big advantage over IRR. Now come back to this question. See what is happening in this case, that three projects have been given, A, B, and C, right? So Protec Limited is evaluating. Let me zoom a little bit. Right. Protec Limited is evaluating three manufacturing projects A, B, and C. For project A, initial investment 5 lakh, discounted cash inflow 6 lakh, profitability index they have given. B, C they have given. All every data have been given. Right. Now what happened? The CFO say go for project A because the PI is the highest. The CEO say that project project B gives us 12 lakh in return, right? It gives us 12 lakh in the return, that is double of what A give. Now the question is, which of the following explain why profitability index might not be the sole criteria for project selection, right? So which project to choose, right? Option number A, PI ignore absolute return, favoring a small project with high ratio of a larger one. PI means profitability index. PI assume constant reinvestment rate, which may distort ranking in dynamic market. Option number C, project with PI less than 1 can still be profitable depending on cash flow timing. And option number D, net present value is always better than PI regardless of project scale. This PI, which means profitability index, is another way of evaluating the project. This is another way to evaluate the project, right? So let us break it down. What is the meaning of PI? Let me explain. Imagine that you invested rupees 1. You have invested 1 rupees and you get back 1.20, right? That is great, right? You have invested 1, you have get 1.20 back. So PI tells us it is the return per 1 rupees invested. PI, what it tells us, what is the return you are getting per 1 rupees invested. That is called PI. So what is the formula for PI? The formula for PI is present value of return and divided by initial investment. Means for every 1 rupee you are investing, how much you are getting. That is called PI. That is called profitability index. Now you can see for both project A and B, PI is same 1.20 and 1.20. But here is a twist, that project A gives you 1 lakh profit, isn't it? You can see you have invested 5 lakh and discounted cash inflow is you are getting 6 lakh. And project B, it is giving you 2 lakh profit. You can see it here. So even with the same PI, which give you more money? Obviously project B. So please, one question I'm asking you: which project would you prefer? Option A, a project that gives you more return, per 1 rupees. Option B, a project that gives more rupees overall. Tell me, which one would you choose? Which one would you prefer? Suppose two options are there. Would you prefer a project giving more return per 1 rupee, or would you prefer a project that gives you more rupee overall? You see, that is what is happening in A and B. In case of A and B, both are having the same profitability index, but B is giving you more return. So which project would you choose? Project option A, project having giving more return per 1 rupee. That means project having more PI, or project that is giving you more rupees overall. Option A you are saying. Okay. So that is exactly the debate that CFO and CEO are having. So PI is not all. Obviously option A, no. See, this is, you will choose option number B, not option A. That gives you more rupees overall, right? So PI, that is profitability index, is not always a standalone tool, because it ignores the absolute return. And can favor a small project. As you can see here, right? In this case, what is the profit we are getting? 2 lakh. In this case, what is the return? It's just 1 lakh, right? So PI ignore absolute return and can favor a small project. It tells us how profitable the project is per rupee invested, but now how much total profit we are making, right? You can think of it like this. Suppose you sell 10 cup of tea. Try to understand. You are selling, let me change the color, right? Suppose you are selling 10 cup of tea, right? With rupees 2 profit each. So on 1 cup of tea, you are getting rupees 2 profit. You are selling 10 cup of tea, which rupees 2 profit on 1 cup of tea. But someone else sell 1,000 cup of tea with just 1 rupees profit. So who is earning more overall? Right, obviously this one. So you have just sold 10 with 2 rupees profit per tea, but someone is selling 1,000 cup of tea with 1 rupees profit. So obviously this thousand person is earning more. That is why volume matter. That is why volume always matter. So what we learned. So what is the answer to this question? So tell me, what is the answer to this question? So the answer is option number A, that PI ignored absolute return. Yes, this is the limitation of PI, right? So the PI ignored absolute return. It favors a smaller project with higher ratio over larger one. This is one of the limitation of PI. How do we calculate the PI? Per rupee you have invested, how much you are getting. That is called PI, right? So that is one of the limitation of profitability index, right? So it just tells you how much profit you are making per rupees invest. It is great, it is great for comparing relative profitability. But when project differ in size, PI alone can be misleading. So what we do, we use PI plus NPV, right? Both are used simultaneously to make a smarter decision, right? To make a smart decision, we use profitability index as well as NPV, right? That is what we do. So option number A is the correct answer here. It ignored the absolute return. That is the limitation of PI, right? Now let's look at this particular question. Again, one question based on ARR, right? This one is little bit different, right? I think we have already discussed ARR. Let's come back to it. What is happening? A manufacturing company is planning to invest 50 lakh in a new machine, and machine life is given 5 year, right? No salvage value. Project is expected to generate a total return of 30 lakh over its life, and company can use straight line depreciation. So what is the ARR for this project? And tell me, what is the ARR? We have already discussed the ARR, accounting rate of return. So it is the average return that you earn every year on your original investment. It's like asking, suppose I invest 1 rupee, how much profit do I get back every year on average, right? That is called accounting rate of return. So here nothing is mentioned which version to use, right? So what we will do, we will apply the simple version. We will apply the simple version, right? So what is the formula for ARR? Just can you tell me, calculate the ARR? What is the ARR value? So it is nothing but average annual profit in the numerator. Overall ARR you have to find, divide by initial investment, right? Multiplied by 100. So ARR use accounting. One thing you must note it down. ARR use accounting profit, right? ARR use what? Accounting profit, right? It does not use the cash flow. That is the difference. ARR always use accounting profit. ARR does not use the cash flow. That is why we must adjust for depreciation. This is one point. So you have to adjust for depreciation. So can you calculate what is the average annual profit? Can you calculate what is the average annual profit in this case? Please tell me what is the average annual profit in this case. So this profit, you can see this 6,000. What here you can see. So see how much is the project is to generate total earning of 30,000, 30 lakh over its life. Fine. And so what is the depreciation per year? So first thing, average annual profit. What is the average annual profit? Total earning is how much? 30 lakh. So how much is the average annual profit? It is nothing but 30 lakh divided by what? How many year? 5 year. So that is average, which is how much? 6 lakh. So 6 lakhs your average annual profit, right? But we have to take depreciation also into account because it shows accounting profit. What is the depreciation per year? Because it is written straight line depreciation, so it means depreciation will uniformly decrease over the year. So depreciation per year will be how much? 50 lakh, which is the initial amount, divided by 5, which is how much? 10 lakh. So this 10 lakh is the depreciation, right? 10 lakh is the depreciation. So we add back the depreciation because it is a non-cash expense. We have already discussed it, right? This depreciation, it just kept on the paper, it just written on the paper, but it not actual decrease. So since it's a non-cash expense, so we add it back. right? So what is the adjusted profit? What is the adjusted profit? Adjusted profit is 6 lakh plus plus 10 lakh, right? Depreciation. So it is how much? 16 lakh. So this is your adjusted profit. Now we have to find the ARR. So what is ARR? 16 lakh divided by initial investment. How much we have invested? 50 lakh, right? So how much it is? I think it is 32%. Right, 32% will be more accurate here. Right. So I think there is some mistake in the option. So this way you have to calculate it, it is 32%. And what is the benchmark? It is 15%. So you should accept the project. Right. Minimum required ARR is 15%. You should accept the project. You will add back the depreciation to calculate the adjusted profit. And that is how we calculate the ARR in this particular case. Now friends, let's come to CAPM. That is called, what is CAPM? CAPM formula we will apply in this case. So what is happening here? That imagine that you are a venture capitalist, right? Someone who invests in risky startup, and you are hoping for a return. So here you can see risk-free rate they have given is 4%, expected market return is 12%, and beta value they have given is 1.8, right? So using CAPM, what return should you demand from this startup to compensate for its risk? So what is CAPM? CAPM, is capital asset pricing model. Capital asset pricing model. So it helps investor answer this question that how much return should I expect for taking on the extra risk? This venture capitalist is taking the extra risk. So obviously, since they are taking extra risk, so they should get the extra return, right? So this CAPM tells the answer that how much return should I expect for taking the extra risk. So can you tell me how to go about calculating the extra risk? Basically, there is a formula. There is a formula to calculate the CAPM. So the formula is, it is very simple. That it says that required return. It says required return, which is RE. RE is equal to risk-free return plus beta multiplied by market return minus risk-free rate. Right. So this formula you have to apply. So now in this case, what is R? What is the meaning of risk-free return? So can you apply the formula? Just put the value. So what is the risk-free return? Risk-free return means what you earn with zero risk. There are some investment where risk is zero, like government bond is there, right? That is risk-free rate. And what is the market return? So in short, we can also write it like this: RE is equal to RF plus beta multiplied by RM minus RF. So this is the formula. So what is market return? Market return means what you expect from the entire market. And what is the risk rate? We have already discussed. What is this beta? Beta, this means how much riskier the stock is as compared to the market, right? So just you have to plug in the value. So the formula is RF plus beta multiplied by RM minus RF. So what is RF here? So RF is 4%. What is beta? Beta is 1.8. What is RM? This is 12%. What is RF? RF is again 4%. So how much you are getting? Okay. So let me explain. See, 4% plus 1.8 times 8%. So 1.8 times 8, how much it is? 14.4%. So the answer is 18.4%, right? So option number B is the answer, right? So this formula you have to remember to calculate the adjusted required rate of return, right? So this is the minimum return that investors should demand. Minimum return based on the risk they are taking. How much return they should demand? 18.4% return they should demand. So CAPM, what is the implication of CAPM? It shows you the minimum return that investor should expect based on the risk they are taking. And if beta increase, higher the beta, higher the required return. RE will increase, right? So that is the point. Just this formula and you can answer it question. This is the formula we have used. Now let's look at this question. So basically investor is comparing two stock. This is called CAPM. CAPM stock comparison, right? Capital. What is the full form of CAPM? Remember, capital asset pricing model. Now friends, come back to this question. Let's say you are investor checking out two options. Stock A is there in utility company, very stable, beta is 0.6, and stock B is there in the biotech firm, and which is high growth and beta is also higher, 1.5. So market condition given, risk free rate is 5% and market return is 10%. So which of these has the highest expected return? Which statement is correct based on the CAPM, right? So CAPM answer, if I take more risk, how much more return should I expect? Right. So option number A, that stock A has higher expected return because it is less volatile. Option number B, stock B required return is 12.5%. Option C, both having the same return. Option D, stock A required return is negative. So can you calculate the rate of return? Just apply the formula. Yes, 18.4 is the correct answer in the to the previous question, right? I think you are answering the previous one. Very good. Now can you calculate here? What is the required rate of return for stock B and stock A? First of all, let's calculate stock A. So for stock A, RE is equal to risk free rate is 5% plus beta is 0.6 multiplied by RM is 10%. 10% minus 5%. So how much it is? So 10 minus 5 is 5. 0.6 of 5 is 0.6 of 5 is 3, right? So 5 plus 3, it is 8%. For stock A, it is 8%. What about stock B? What about stock B? For stock B, beta they have given it 0.5, right? So RE is equal to 5% plus 1.5 multiplied by 10% minus 5%. So how much it is? It is 5% plus 7.5%, right? I think it is 12.5%. So you can see for stock A, RE is 8%, for stock B, RE is 12.5%. So stock B should offer at least 12.5% return to match its risk. And stock A is low risk, low return as expected. So now tell me which option is correct? Is it A, B, C, and D? Yes, correct. It is B. Because stock B required return is 12.5%, reflecting it higher risk, right? 12.5%. So because you can is it clear? Please tell me. I hope it is clear that how to find the required rate of return for both the stock. Just you have to apply the formula using CAPM, capital asset pricing model, right? So what we learn from this question is that if beta is higher, you can see for stock B beta is higher, right? So what is the learning from this question? That if beta is higher, it means risk is higher. It means return it will also be higher. Like in the case of stock B, you can see beta is higher, risk is higher, return will also be higher, right? Please tell me, is it clear now? How to go about calculating the CAPM? Very good. Now let's do one more question. So see this question. This is a good question on APT. See what is happening in this case. Let me explain. Imagine a company called Beta Security. The company name is Beta Security. Let me zoom a little bit, right? And it is evaluating a stock. So this is now we are evaluating a stock. We are doing evaluation of a stock, right? They are evaluating a stock using arbitrage pricing theory, using APT, which unlike CAPM use multiple economic factor. In CAPM only use one economic factor, while this APT use multiple economic factor. Like you can see GDP growth, inflation rate, gold price, stock market index return. These are the multiple factors to calculate the expected return. The goal is simple. The goal is to calculate the expected return. This is the goal, right? But in this case, they are using the multiple factor: GDP growth, inflation rate, gold price, etc., etc. Right? So the question is the data have been given. What action should Beta Security take based on APT calculation? Buy the stock, sell the stock, hold the stock, ignore APT. So let me tell you the formula. What is the formula for calculating the expected return using APT? So what you do, first you write the risk-free rate plus beta multiplied by risk premium, right, for each factor, right? So you can think of it like cooking a dish. Suppose you are cooking a dish. You know, in a dish there are very many ingredients. So many ingredients are there, and each ingredient is adding its flavor, right? And you add all of them, right? So basically here it will be summation will be more suitable here. Summation to use. So now here factor has been given, and you know beta and risk premium have been given. So what I will do, I will draw a table here. The table is the best way to calculate it, right? So we have to calculate what? We have to calculate the expected return. So no need to draw table, you can see. What about the GDP growth? See, we will calculate the expected return step by step. So just multiply this 0.5 with 3%. 0.5 multiplied by 3, it is 1.5%. Then 0.7 multiplied by 2. 0.7 multiplied by 2, it is 1.4%. Then minus, see my negative, it is beta is negative, minus 0.6 multiplied by 4%. How much is this? It is minus 2.4%. And here 1.2 multiplied by 8%. How much it is? 9.6%. Now you add all of them. You add all of them, and you have to add what, you know, this risk-free rate 2%. So first write risk-free rate 2% plus 1.5 plus 1.4 plus, so minus 2.4 plus 9.6. What is the final answer? Tell me what value you are getting. This is the formula to calculate the risk required return using APT, arbitrage pricing theory, right? So multiply beta with the risk premium, add all of them, and you also add the risk free rate. So 2 plus 1.5 is 3.5. 3.5 plus 1.5 is 4.9, and plus 9.6 minus 2.4. So I am getting 14.6. Are you also getting the same? I hope you are also getting the same, 14.6. So this is what you get, risk expected return. So basically, do you think that a stock is undervalued? Right? Do you think that because the stock market price suggests return of 12%? See what is happening here, that the stock market price suggests return of only 12%, and now we have get 14.6%. Do you think that a stock is undervalued if its actual return is less than what models say? What do you think? So see what I'm asking you. So the question is what you should do in this case, buy the stock or sell the stock. So APT says, what APT is saying, that a stock should give 14.6%, but the market return is only how much? 12%. So isn't it an arbitrage opportunity? It is an arbitrage opportunity, right? You know what is the meaning of arbitrage? In BFM we have learned the arbitrage, right? So the stock is undervalued, right? The APT is telling that return should be 14.6%, but the market price is suggesting the return of only 12%. So here we can take the arbitrage opportunity. And a smart investor grabs such chance, right? The smart investor, one who is smart, they grab such kind of such chance. So what they should do? Option A, buy the stock. Option A, buy the stock as the calculated expected return exceed the market return. Please answer now. I hope I have given you sufficient insight. Option B, sell the stock as the calculated expected return is lower than the market return. Hold the stock and ignore APT. What do you think? Should they buy the stock? See, market is suggesting a return of only 12%, but APT says that return is 14.6%. What should you do? So that is what you have to answer. So basically this stock is undervalued. Valuation is less as per the market. The correct valuation should be 14.6%, but market is just only saying 12%. So whenever a stock is undervalued, what should you do? You should buy the stock or you should sell the stock. Just waiting for your answer. Right? This is what arbitrage opportunity. Yes, option number A, very good. You should buy the stock. Yes, this is what you should do. Right? Because you should buy the stock as it is undervalued. Why option B is incorrect? The sell the stock. Because return is higher, not lower. Right? Because it's saying that calculated expected return is lower. No. It is higher. Had it been lower, then we will sell the stock. Hold the stock. This is wrong. APT whole point of view is to spot mispricing and act on it. You can see that is why it is called arbitrage pricing. Why it is called arbitrage pricing? I think you know the answer. Why it is called arbitrage pricing? This question explain it. Why there is a mispricing here, isn't it? This is called mispricing. This is mispricing which has happened here, right? The correct pricing is 14.6 and market is only telling 12%. So this is called mispricing, and you take advantage of this mispricing. You buy the stock as it is undervalued, right? And a smart investor grabs such chance. And option D is completely wrong. It ignored APT. That is wrong. But APT gives you deeper insight with more real world variable than CAPM, right? Please tell me, is this concept clear or not regarding APT? I have given you every dimension of APT, right? That how you can calculate the required rate of return, why it is good as so if I ask you which method is more good, CAPM or APT, what would your answer would be? Which method is more would you prefer? CAPM, that capital asset pricing model, or this arbitrage pricing theory? Tell me which method is more preferable. And why it is called arbitrage pricing? Because it takes advantage of mispricing, right? Undervalued stock, like you can see in this particular question, right? Very good. So friends, that's all for today, right? We have covered starting from accounting rate of return, IRR, NPV, right? Net present value, and we have seen CAPM, right? Yes, obviously arbitrage pricing model is very good, is very good in comparison to the CAPM model, right? So I again request you to please go through this video and PDF, right? We are trying to cover every aspect from where question can be asked, right? So the PDF and videos will be available in your course, right? And we will meet back again. I will share the timing, right? So that's all for today. Hopefully you enjoyed today's session. It was useful for you. If you have any doubt in any question, you can post in the Telegram group also, right? And we will continue our session, right? Yeah, tomorrow I'm thinking, because I think tomorrow is holiday, right? So I may conduct. I will provide the update in the Telegram group, right? I will share you the update in the Telegram group. So keep checking that, right? So that's all for today. Thank you. Yes. Tomorrow is holiday, I know. So that is why I will conduct. I will most probably conduct. I will share the timing. Right. Most probably this timing also. Okay. Thank you.